Welcome to Finance for Sleep. I am Simon Grant and it is a pleasure to have you here. The mission of this channel is to transform the complex, often stressful world of money into a landscape of absolute calm. We believe that the most technical details of finance possess a natural steady rhythm that can settle an overactive mind. Whether we are exploring market history or tax codes, our goal is to provide a sanctuary where high-level information meets low-level stimulation. For those who wish to delve deeper into these topics, we have provided additional resources and references in the links below. Some of these are affiliate links, which help support the channel's mission at no additional cost to you, allowing us to continue building the Finance for Sleep library. Tonight we begin our journey into a series I call Boring Finance from A to Z. Together we are creating a comprehensive library of the language of wealth, a fiscal dictionary designed to be as informative as it is monotonous. Before we move into the ledger, a few necessary words on safety and professional boundaries. This series is designed specifically for relaxation. Therefore, you should not listen to this audio while driving or operating heavy machinery. For the most immersive experience, it is recommended to listen with headphones at a low and comfortable volume. This content is for educational, entertainment, and lack of entertainment purposes only. It does not constitute financial, legal, or medical advice. I am not a lawyer, medical professional, or financial advisor. You should not act or refrain from acting based on anything you hear in this video. Always consult with a qualified, licensed, and certified professional before making any decisions. If you find these sessions helpful for your rest or for your growth, please consider joining our community by subscribing. It helps us continue to grow this channel and make more videos that bore you to sleep. Now, let us continue towards a peaceful night's sleep. Tonight we will be covering financial words beginning with the letter A. From the foundation of assets to the rhythmic cycle of accounting, each word will be defined, explored, and eventually laid to rest. There is no rush and no requirement for your full attention. Let the terms and the quiet logic of finance drift through the room as you settle into the stillness. Make yourself comfortable as we begin our journey through finance, one letter at a time. Abandonment value. The definition of the word abandonment value is the net cash value of a project or an asset if it were to be liquidated or shut down immediately. Imagine a quiet empty factory at dusk. The machinery has stopped humming. An appraiser walks through the aisles with a clipboard, calculating what the heavy steel and the copper wiring would be worth if the building were simply closed today. It is a calculation of the floor, the absolute base of value. In capital budgeting, abandonment value is considered an exit option. It is often mathematically modeled using decision trees, where each branch represents a potential future path, leading eventually to a single quiet conclusion. Abatement. The definition of the word abatement is a reduction or an exemption in the amount of tax or a claim levied by a government or a company. Picture a thick stack of paperwork on a wooden desk. A small stamp is pressed onto the top page, reducing a number. It is a lowering of pressure. Like a storm that is finally passing, an abatement allows the financial atmosphere to become calm and manageable again. The word abatement comes from the Old French word abattre, meaning to beat down. In modern real estate, tax abatements are often granted for a period of 10 to 15 years, creating a long predictable horizon of lower expenses. Above-the-line deduction. The definition of the phrase above-the-line deduction is a deduction that reduces your adjusted gross income and can be claimed even if you do not itemize. Think of a tax return as a very long form. There is a horizontal line drawn across the middle of one page. Above this line, certain deductions are subtracted first, before anything else is calculated. It is a privileged position, a reduction that comes early and applies to everyone. Common above-the-line deductions include student loan interest, educator expenses, and contributions to traditional IRAs. These deductions were separated from itemized deductions in the Tax Reform Act of 1986, creating a clear two-tiered system. Absentee owner. The definition of the phrase absentee owner is a person or entity that owns a property but does not live in it or actively manage it. Imagine a small apartment building on a quiet street. The owner lives 3 states away. Once a month, a property manager walks through the hallways, checking the heating systems and collecting the rent. The owner receives a simple report in the mail, a few pages summarizing everything that happened while they were far away. Absentee ownership is common in commercial real estate. Studies show that absentee-owned properties often have slightly lower maintenance scores but higher tenant turnover rates due to the distance between decision-maker and property. Absolute return. The definition of the phrase absolute return is the total gain or loss an investment makes over a specific period, regardless of how the rest of the market performs. Think of a single tree growing in a vast garden. While the wind may blow and other trees may sway, this specific tree grows exactly 3 inches every year. It does not care about the garden. It only cares about its own steady upward progress. Absolute return strategies often utilize various complex techniques, such as short selling or derivatives, to ensure that the final number remains positive, aiming for a steady line on a graph that avoids the jagged peaks of market volatility. Absorb. The definition of the word absorb is to take in or to assume the cost or the responsibility for something, often without passing it on to others. Picture a thick sponge sitting on a countertop. Water is slowly poured onto it. The sponge quietly takes in every drop, holding the liquid inside without letting it spill over the edges. A company absorbs costs in the same way, holding them internally rather than raising prices. In manufacturing, the decision to absorb versus to pass on costs is a strategic one. Many companies will absorb small cost increases of less than 3% to maintain customer loyalty and avoid frequent price adjustments. Absorption costing. The definition of the phrase absorption costing is an accounting method that includes all manufacturing costs, both fixed and variable, in the cost of a product. Imagine a factory that makes wooden chairs. Each chair's cost includes the wood, the labor, the electricity for the saws, and even a small portion of the factory manager's salary. Everything that touches the production line is absorbed into the final price of the chair. Nothing is left out. Absorption costing is required by generally accepted accounting principles, or GAAP, for external financial reporting. It contrasts with variable costing, which only includes costs that change with production volume, creating two different pictures of profitability. Abstract of title. The definition of the phrase abstract of title is a condensed historical record of all the documents that affect the ownership of a specific piece of real estate. Imagine a very old leather-bound book in a library basement. Inside are thin pages of parchment, listing every person who has ever owned a small plot of land. One name follows another in a long slow chain of history, stretching back 100 years. An abstract includes deeds, mortgages, and even quiet easements. Each entry is checked by a title examiner who moves slowly through the records, ensuring that the chain of ownership is unbroken and silent. Abundance. The definition of the word abundance is a state where there is an ample supply of capital or resources available for investment. Picture a calm reservoir filled to the brim with water. The surface is perfectly still. There is more than enough to go around, and the water sits there, heavy and quiet, waiting to be directed toward the fields below. The abundance mindset is often contrasted with scarcity. In economic terms, when capital is abundant, interest rates often settle at a lower, more restful level, as there is less competition for the available funds. Accidental death benefit. The definition of the phrase accidental death benefit is an additional payment made by an insurance policy if the insured person dies as a result of an accident. Think of a life insurance policy as a promise written on paper. Most of the time, the promise is simple and straightforward. But there is a small clause at the bottom that says if death comes suddenly, unexpectedly, from an accident, the payment doubles. It is a quiet addition, rarely discussed until it matters. Accidental death benefits often exclude deaths from certain high-risk activities, such as skydiving or professional racing. The additional payout is typically equal to the face value of the policy, effectively doubling the benefit in specific circumstances. Claude is AI and accidental high yielder. The definition of the phrase accidental high yielder is a stock that has a high dividend yield, not because the company increased its dividend, but because the stock price has fallen significantly. Imagine a fruit tree in an orchard. Every year it produces exactly 10 apples. One year the tree itself becomes smaller, shrinking down to half its size. The 10 apples are still there, but now they seem much larger in proportion to the tree. The yield appears high, but only because the tree itself has diminished. Accidental high yielders are often seen as value traps. The elevated yield, which might be 6 or 7%, can attract income investors but may signal underlying financial distress rather than generosity. Accommodation endorsement. The definition of the phrase accommodation endorsement is when a person signs a promissory note, not as the borrower, but to help another person obtain credit. Picture two people standing at a bank counter. One needs to borrow money but does not have enough trust from the bank. The second person, who has nothing to gain, steps forward and signs the document as well. It is an act of faith, a quiet gesture of support that carries real financial weight. An accommodation party is liable for the debt if the primary borrower defaults. This practice was more common in the 19th century, when personal reputation and relationships were central to commerce, and legal documents were signed in the presence of witnesses. Accommodative policy. The definition of the phrase accommodative policy is a monetary policy stance by a central bank designed to stimulate economic growth by lowering interest rates and increasing money supply. Imagine a gardener tending to a slow-growing plant. The gardener adds more water, loosens the soil, and ensures the plant receives extra sunlight. The goal is simple: to encourage growth. An accommodative policy does the same thing for an economy, providing easier conditions and more resources to help activity expand. The Federal Reserve typically adopts an accommodative stance during recessions. Interest rates may be lowered to near zero, and programs like quantitative easing may be introduced, creating a prolonged period of easy credit that can last several years. Accountability. The definition of the word accountability is the obligation of an individual or organization to account for its activities and accept responsibility for them. Picture a ledger where every single penny is tracked. There is a column for every action. At the end of the year, a person sits quietly and ensures that every number matches the one next to it. It is the peace that comes from knowing exactly where everything stands. In corporate governance, accountability is enforced through regular audits and financial reports. These reports are often hundreds of pages long, filled with small orderly numbers and detailed footnotes that explain the history of every transaction. Accountant. The definition of the word accountant is a professional who records, classifies, and reports financial transactions for individuals or organizations. Think of a person sitting at a desk in a quiet office. Papers are stacked neatly in rows. A calculator sits within reach. The accountant moves through each document slowly, entering numbers into columns, ensuring that debits equal credits and that every figure has its proper place. Accountants can be certified in various ways. A certified public accountant, or CPA, must pass a rigorous 4-part examination and complete continuing education requirements. In the United States, there are approximately 650,000 active CPAs, each maintaining detailed records for their clients. Accounting cycle. The definition of the phrase accounting cycle is the collective process of identifying, analyzing, and recording the accounting events of a company. Think of the changing of the seasons. First there is the recording, then the adjusting, and finally the closing of the books. It is a circle that repeats every month and every year, with the same predictable steps over and over again. The cycle typically consists of 8 steps, beginning with the recording of transactions in a journal and ending with the post-closing trial balance. It is a closed loop designed to ensure absolute mathematical harmony. Accounting insolvency. The definition of the phrase accounting insolvency is a situation where a company's liabilities exceed its assets, even if it can still meet its current obligations. Imagine an old wooden house. From the outside it looks solid. The paint is fresh, the windows are clean. But inside the walls the foundation has slowly crumbled. The structure owes more than it is worth. It is still standing for now, but the numbers tell a different story. A company can be accounting insolvent but still cash flow solvent. This means it can pay its bills today, but if all debts were called immediately, there would not be enough assets to cover them. This distinction is critical in bankruptcy proceedings, where timing determines outcomes. Accounting method. The definition of the phrase accounting method is the set of rules a business uses to determine when to record income and expenses. Picture two calendars hanging on a wall. One marks the day money is received. The other marks the day the work is actually completed. A business must choose which calendar to follow. This choice shapes every financial statement and changes the rhythm of reported profit. The two primary methods are cash basis and accrual basis. Cash basis records transactions when money changes hands, while accrual basis records them when earned or incurred. Most large businesses are required to use the accrual method, which provides a more accurate long-term picture, even if it is more complex to maintain. Accounts payable. The definition of the phrase accounts payable is money that a company owes to its suppliers or creditors for goods or services received but not yet paid for. Think of a stack of invoices in a tray on a desk. Each one represents something already delivered: a shipment of paper, repair to a machine, consulting service. The bills sit there quietly, waiting for the scheduled payment date to arrive. They are obligations, recorded and tracked, but not yet settled. Accounts payable is considered a current liability. Companies often negotiate payment terms of 30, 60, or even 90 days. Managing this balance carefully allows a business to use its cash efficiently while maintaining good relationships with vendors. Accounts receivable. The definition of the phrase accounts receivable is money owed to a company by its customers for goods or services that have been delivered but not yet paid for. Imagine a row of mailboxes outside an office. Each one contains a check that has not yet arrived. The work has been done, the invoice has been sent, and now the company waits. These future payments are recorded today as assets, even though the money is still somewhere in transit. The average collection period for accounts receivable varies by industry. In retail, it might be just a few days. In construction or manufacturing, it could extend to 60 or 90 days. Companies monitor this metric closely, as slow collections can strain cash flow. Accounts receivable financing. The definition of the phrase accounts receivable financing is the process of using outstanding invoices as collateral to obtain a loan, or selling them outright to raise immediate cash. Picture a company with a stack of unpaid invoices. Instead of waiting weeks for customers to pay, the company takes the stack to a lender. The lender advances most of the money right away, perhaps 80 or 90%. When the customers finally pay, the lender takes a small fee and returns the rest. It is a way to turn patience into immediacy. This practice is also called factoring. It is common in industries with long payment cycles, such as manufacturing or freight. The cost, typically 2 to 5% of the invoice value, is the price paid for accessing cash sooner. Accounts receivable turnover. The definition of the phrase accounts receivable turnover is a ratio that measures how many times a company collects its average accounts receivable balance during a period. Imagine a conveyor belt moving through a factory. Items arrive at one end, move steadily across, and drop off at the other side. The turnover ratio counts how many full cycles the belt completes in a year. A higher number means the belt moves faster, and cash is collected more quickly. The formula is net credit sales divided by average accounts receivable. A turnover of 12 means the company collects its receivables, on average, once per month. Industries with quick turnover, like grocery stores, might see ratios above 50, while heavy equipment manufacturers might have ratios closer to 4 or 5. Acreage. The definition of the word acreage is the total land area of a property, measured in acres. Think of an open field stretching toward a distant tree line. The land is measured carefully, using chains and markers, until a final number is written on a deed. 1 acre equals 43,560 square feet. It is a specific, unchanging measurement that turns the vague idea of space into something precise and legal. In real estate valuation, acreage is often the first factor considered. Agricultural land is typically valued per acre, with prices varying widely based on soil quality, water access, and location. In rural areas, large acreage parcels may sell for a few $1,000s per acre, while in urban zones, even a fraction of an acre can be worth millions. Accreditation. The definition of the word accreditation is formal recognition by an official body that an individual or organization meets certain standards. Imagine a diploma hanging in a wooden frame on an office wall. It represents a long process of study, examination, and verification. The diploma says that someone else, an authority, has looked carefully at the person's qualifications and decided they meet the necessary criteria. It is a stamp of approval that carries weight. In the context of finance, accreditation often refers to investors. An accredited investor must meet specific income or net worth thresholds, as defined by the Securities and Exchange Commission. This status allows access to certain private investments that are not available to the general public. Accredited investor. The definition of the phrase accredited investor is an individual or entity that meets specific financial criteria, allowing them to invest in securities not registered with regulatory authorities. Picture a door in a quiet hallway. Most people walk past it. Only a few, those who meet certain requirements, given a key. Behind the door are investment opportunities that carry higher risks and potentially higher rewards. The key is proof of financial sophistication. To qualify as an accredited investor in the United States, an individual must have earned income exceeding $200,000 per year for the last 2 years, or have a net worth exceeding $1 million, excluding their primary residence. These thresholds are intended to ensure that investors can withstand potential losses. Accretion. The definition of the word accretion is the growth of value through the gradual accumulation of interest or the addition of new assets. Imagine a slow-moving river carrying tiny grains of sand. Over many years, the sand settles at the bottom, slowly building up a new bank of land. You cannot see it happening, but day by day, the ground becomes more solid and the bank becomes wider. In finance, accretion of a discount is the increase in the value of a discounted instrument, like a bond, as it moves toward its maturity date. It is a slow, mathematical crawl toward a final, full value. Accretive. The definition of the word accretive is something that increases value or earnings per share, typically used to describe mergers or acquisitions. Think of two streams joining together to form a river. the combined flow is stronger and deeper than either stream alone. When a company acquires another, and the deal is accretive, it means the merged entity is immediately more profitable per share than the original company was. It is an addition that enhances rather than dilutes. Investment bankers analyze whether a proposed merger will be accretive or dilutive. If the target company's earnings, relative to its purchase price, higher than the acquirer's price-to-earnings ratio, the deal is typically accretive. This calculation is central to merger negotiations. Accretive acquisition. The definition of the phrase accretive acquisition is the purchase of another company that immediately increases the acquiring company's earnings per share. Imagine a garden where each plant produces a certain amount of fruit. A gardener buys a neighboring plot and adds its plants to the garden. If the new plants produce more fruit per dollar spent than the original garden, the acquisition is accretive. The overall harvest per unit of investment goes up. For an acquisition to be accretive, the earnings yield of the target, calculated as earnings divided by purchase price, must exceed the acquirer's own earnings yield. This is why companies with high stock prices often make accretive acquisitions of undervalued targets. Accrual. The definition of the word accrual is the recognition of revenue or expenses that have been earned or incurred but not yet received or paid in cash. Picture a librarian marking down a book as checked out, even though the book will not be returned for 3 weeks. The transaction is recorded now, even though the physical exchange will happen later. Accruals work the same way, capturing economic reality before cash changes hands. The accrual principle is fundamental to modern accounting. It ensures that financial statements reflect the true performance of a period, rather than just the timing of cash flows. Without accruals, a company could appear profitable one month and broke the next, simply based on when checks arrived. Accrual accounting. The definition of the phrase accrual accounting is a method of accounting that records revenues and expenses when they are earned or incurred, regardless of when cash is exchanged. Imagine a teacher giving a student credit for completing an assignment, even if the grade will not be officially recorded until next month. The work has been done, so the recognition happens now. Accrual accounting operates on this same principle, honoring the substance of transactions over their timing. This method is required by generally accepted accounting principles for most businesses. It contrasts with cash accounting, which only records transactions when money moves. Accrual accounting provides a clearer picture of long-term profitability, though it requires more complex record-keeping. Accrual basis. The definition of the phrase accrual basis is the accounting method where transactions are recorded when earned or incurred, not when cash is received or paid. Think of a calendar where every commitment is marked on the day it is made, rather than the day it is fulfilled. A promise to pay in 30 days is written down today. A sale made on credit is counted immediately. The calendar fills with obligations and achievements, all recorded at the moment of their creation. Companies using accrual basis must track accounts receivable and accounts payable carefully. This creates a more accurate financial picture but also requires reconciling the difference between accounting profit and actual cash on hand. Accrual bond. The definition of the phrase accrual bond is a bond that does not pay periodic interest but instead accumulates the interest and pays it all at maturity. Imagine a sealed jar where coins are dropped in every month. The jar cannot be opened until a specific date arrives. The coins accumulate silently inside, invisible but growing. When the date finally comes, the jar is opened and all the coins are counted at once. An accrual bond works the same way. Zero-coupon bonds are a common type of accrual bond. They are sold at a deep discount to face value, and the difference between purchase price and maturity value represents the accumulated interest. This structure is often used for long-term savings goals where current income is not needed. Accrued expense. The definition of the phrase accrued expense is an expense that has been incurred but not yet paid, recorded as a liability on the balance sheet. Picture a utility bill that arrives on the first of the month for electricity used in the previous month. The electricity was consumed weeks ago, powering lights and computers every day. Even though the bill has not been paid yet, the expense is real and must be recorded. It sits as a quiet obligation, waiting to be settled. Common accrued expenses include wages, interest, and utilities. Companies record these at the end of each accounting period to ensure that expenses match the period in which they were incurred, following the matching principle of accounting. Accrued interest. The definition of the phrase accrued interest is interest that has accumulated on a loan or bond but has not yet been paid. Think of a clock ticking quietly in the corner of a room. Each tick represents a small amount of interest accumulating on a loan. The clock does not ring or make any announcement, but the time keeps adding up. When the payment date finally arrives, all those accumulated ticks are counted and settled in one transaction. When bonds are sold between interest payment dates, the buyer pays the seller accrued interest for the time the seller held the bond. This ensures that each party receives interest only for the period they actually owned the security, creating a fair and predictable system. Accumulated depreciation. The definition of the phrase accumulated depreciation is the total amount of depreciation expense that has been recorded against an asset since it was acquired. Imagine a delivery truck that was purchased 5 years ago. Each year, a small portion of its value is recorded as an expense, reflecting wear and tear. These amounts are added together year after year, creating a running total. The truck still sits in the parking lot, but on paper, a growing shadow of used-up value follows it. Accumulated depreciation appears on the balance sheet as a contra-asset account, reducing the book value of fixed assets. If a machine cost $100,000 and has accumulated depreciation of $60,000, its net book value is $40,000. Accumulated earnings tax. The definition of the phrase accumulated earnings tax is a penalty tax imposed on corporations that retain earnings beyond the reasonable needs of the business to avoid shareholder income taxes. Picture a reservoir designed to hold water for irrigation. The reservoir fills slowly throughout the year. But if the water level rises too high and never flows out to the fields, regulators become suspicious. They wonder if the water is being hoarded deliberately. The accumulated earnings tax works the same way, discouraging corporations from holding excessive profits without distributing them. This tax is assessed at a rate of 20% on accumulated taxable income. The IRS presumes that accumulations over $250,000 for most corporations are unreasonable, unless the company can justify the retention for specific business purposes. Acid test ratio. The definition of the phrase acid test ratio is a measure of a company's ability to pay its short-term liabilities using only its most liquid assets. Think of a person standing at a checkout counter with a wallet. The cashier asks for payment immediately. The person cannot offer a promise or a future paycheck, only the cash and cards currently in the wallet. The acid test ratio measures exactly this, the ability to pay right now with what is immediately available. Also known as the quick ratio, it is calculated by dividing liquid assets, such as cash and accounts receivable, by current liabilities. Inventory is excluded because it cannot be converted to cash quickly. A ratio above 1 indicates the company can cover its short-term obligations without selling inventory. Acid test liquidity ratio. The definition of the phrase acid test liquidity ratio is another name for the acid test ratio or quick ratio, measuring immediate liquidity. Imagine a bucket filled with different types of assets. Some are liquid like water, easily poured and moved. Others are solid like rocks, valuable but immovable in the short term. The acid test liquidity ratio counts only the liquid portions, the assets that can flow immediately to meet obligations. Financial analysts use this ratio to assess a company's financial health during stress periods. A ratio below 1 may indicate potential cash flow problems, while a ratio significantly above 1 suggests strong short-term financial stability. Acquisition. The definition of the word acquisition is the act of gaining control of another company through purchase or merger. Picture two puzzle pieces. One company holds the first piece, the other holds the second. When an acquisition happens, one company reaches across the table and takes the second piece, joining them together. The combined picture is now larger and more complete than either piece alone. Acquisitions can be friendly or hostile. In a friendly acquisition, both boards of directors agree to the terms and recommend approval to shareholders. In a hostile acquisition, the acquiring company bypasses management and appeals directly to shareholders, often by offering a premium price for their shares. Acquisition accounting. The definition of the phrase acquisition accounting is the accounting method used to record the purchase of one company by another. Imagine a detailed inventory being conducted in a newly purchased warehouse. Every item must be counted, valued, and recorded in the new owner's books. Acquisition accounting does exactly this for a company purchase, assigning fair values to all acquired assets and liabilities at the moment of the transaction. The purchase method, now called the acquisition method, requires the acquirer to record all identifiable assets and liabilities at fair value. Any excess purchase price over the fair value of net assets is recorded as goodwill, representing intangible value such as brand reputation or customer relationships. Acquisition cost. The definition of the phrase acquisition cost is the total cost incurred to acquire an asset, including the purchase price and all related expenses. Think of buying a piece of machinery for a factory. The price tag shows one number, but there are also delivery fees, installation charges, and testing expenses. All of these costs are added together to determine the true acquisition cost. Nothing is left out. Every dollar spent to make the asset ready for use is counted. For real estate, acquisition costs include the purchase price, legal fees, survey costs, and title insurance. For accounting purposes, these costs are capitalized, meaning they are added to the asset's value on the balance sheet rather than expensed immediately. Acquisition debt. The definition of the phrase acquisition debt is debt incurred to acquire, construct, or substantially improve a residence, secured by that residence. Picture a family signing mortgage papers at a closing table. The loan they are taking is specifically for purchasing the house sitting before them. The debt is tied directly to the acquisition, and the house itself serves as collateral. If payments stop, the lender can claim the property. It is a clear, direct connection between borrowed money and purchased asset. Under tax law, interest on acquisition debt is generally deductible, subject to certain limitations. The Tax Cuts and Jobs Act of 2017 limited the deduction to interest on acquisition debt of up to $750,000 for mortgages taken out after December 15, 2017. Acquisition indigestion. The definition of the phrase acquisition indigestion is the difficulties a company faces when trying to integrate a newly acquired business. Imagine eating a large meal too quickly. The stomach struggles to digest everything at once. Systems become overwhelmed, discomfort sets in, and productivity slows. Acquisition indigestion describes this same phenomenon in business, when a company buys another but cannot smoothly absorb its operations, culture, or processes. Common symptoms include employee turnover, customer confusion, duplicated systems, and falling productivity. Studies suggest that between 50 and 70% of acquisitions fail to achieve their intended value, often due to poor integration planning and execution. Acquisition premium. The definition of the phrase acquisition premium is the difference between the price paid to acquire a company and its market value before the acquisition announcement. Think of an antique at an auction. Its listed value is $1,000. But a determined buyer, convinced of its hidden worth, bids $1,500 to secure it. The extra $500 is the premium, the amount paid above market price to ensure the purchase succeeds. Acquisition premiums typically range from 20 to 40% above the target's pre-announcement stock price. The premium compensates shareholders for giving up control and reflects the acquirer's expectation of synergies, cost savings, or strategic value from the combination. Acquirer. The definition of the word acquirer is the company or entity that purchases or takes control of another company. Picture a large tree standing in a forest. Over time, it absorbs a smaller tree growing nearby, its roots spreading to encompass the smaller plant's territory. The large tree is the acquirer, expanding its reach by incorporating another entity into its structure. The acquirer assumes responsibility for integration, bears the financial cost of the transaction, and typically retains decision-making authority over the combined organization. In stock acquisitions, the acquirer's shareholders usually maintain control of the merged entity. Active bond. The definition of the phrase active bond is a bond that is frequently traded on an exchange with relatively high trading volume. Picture a busy marketplace where certain stalls attract constant attention. Customers move in and out, making purchases throughout the day. An active bond is like one of these popular stalls, with continuous buying and selling activity. The price adjusts smoothly because there are always willing buyers and sellers nearby. Active bonds typically include recently issued government securities and highly rated corporate bonds. Their liquidity makes them attractive to institutional investors who need to enter or exit positions quickly without significantly affecting the price. Active management. The definition of the phrase active management is an investment strategy where a portfolio manager makes specific investments with the goal of outperforming a benchmark index. Think of a gardener carefully tending a plot of land. Instead of letting nature take its course, the gardener selects specific plants, prunes regularly, and adjusts based on weather conditions. Active management works the same way, with managers continuously analyzing and adjusting holdings in pursuit of superior returns. Active managers charge higher fees than passive strategies, typically between 1 and 2% of assets annually. The strategy's success depends on whether the manager's decisions generate returns that exceed both the benchmark and the additional costs. Active share. The definition of the phrase active share is a measure of the percentage of a portfolio's holdings that differ from its benchmark index. Imagine two paintings side by side. One is the original, the other is supposed to be a creative reinterpretation. Active share measures how different the second painting is from the first. If 90% of the brushstrokes are identical, the active share is low. If only 10% match, the active share is high. An active share of 0 means the portfolio perfectly mirrors the index. An active share of 100% means no holdings overlap with the benchmark. Studies suggest that portfolios with active share above 80% have better potential to outperform, though success still depends on manager skill. Active strategy. The definition of the phrase active strategy is an investment approach that seeks to outperform the market through security selection, market timing, or both. Picture a chess player studying the board intently. Rather than following a predetermined pattern of moves, the player adapts to the opponent's strategy, seizing opportunities as they appear. An active strategy operates with this same flexibility, constantly seeking advantages through careful analysis and timely decisions. Active strategies can focus on various factors including fundamental analysis, technical indicators, or macroeconomic trends. The approach requires continuous research and monitoring, distinguishing it from passive strategies that simply track an index. Activist investor. The definition of the phrase activist investor is an individual or group that purchases a significant stake in a company to influence its management and strategic direction. Think of a shareholder who does not sit quietly in the background. Instead, they attend board meetings, propose changes, and push for new directions. They might demand cost cuts, leadership changes, or asset sales. The activist investor uses ownership as leverage to reshape the company according to their vision. Activist campaigns often target undervalued companies with operational inefficiencies. The activist typically acquires 5 to 10% of shares, enough to demand attention but not enough to require a takeover. Campaigns can last months or years and often result in board seats or strategic changes. Activity-based costing. The definition of the phrase activity-based costing is an accounting method that assigns costs to products based on the activities required to produce them. Imagine tracking every single step in making a custom piece of furniture. The time spent measuring, cutting, sanding, and finishing is recorded separately. Each activity has a cost, and those costs are traced directly to the final product. Activity-based costing provides this granular view, revealing the true expense of each item produced. Traditional costing often allocates overhead using simple measures like direct labor hours. Activity-based costing instead identifies cost drivers for each activity, such as number of setups, orders processed, or inspections performed. This method provides more accurate product costs but requires more detailed record keeping. Actuals. The definition of the word actuals is the realized results or numbers, as opposed to estimates, budgets, or forecasts. Picture a weather forecast predicting sunshine. When the day arrives, rain falls instead. The forecast was the estimate, the rain is the actual. In finance, actuals represent what truly happened, the concrete numbers that appear in final reports after all transactions are complete. Companies compare actuals to budgets to assess performance. Significant variances between budgeted and actual figures trigger analysis to understand what drove the differences and whether adjustments are needed for future planning. Actuary. The definition of the word actuary is a professional who analyzes financial risks using mathematics, statistics, and financial theory. Think of someone sitting with enormous spreadsheets of data about human life, accidents, and uncertainty. They calculate probabilities with precision, determining how likely certain events are to occur. An actuary turns chaos and chance into orderly predictions that insurance companies and pension funds rely upon. Actuaries must pass a series of rigorous examinations, often taking 7 to 10 years to achieve full certification. They work primarily in insurance, pensions, and healthcare, designing products and setting premiums based on calculated risk levels. Ad valorem tax. The definition of the phrase ad valorem tax is a tax based on the assessed value of an item, such as real estate or personal property. Picture a house sitting on a quiet street. Every year, an assessor determines what the house is worth. The property tax bill is calculated as a percentage of that value. If the house is worth more, the tax is higher. If worth less, the tax decreases. The tax rises and falls with the value itself. The term comes from Latin meaning according to value. Property taxes are the most common form of ad valorem tax. Tax rates are typically expressed in mils, where 1 mil equals 1/10 of 1 cent per dollar of assessed value. Adjacent. The definition of the word adjacent is something that is next to or adjoining something else, sharing a common boundary. Think of two properties separated only by a fence. One yard ends exactly where the other begins. There is no gap, no space between them. They are adjacent, touching along a shared line. In real estate, this proximity can affect value, access rights, and development potential. Adjacent properties may have easement agreements allowing one owner to cross the other's land. Adjacency can increase property value if the neighboring land is desirable, or decrease it if the neighbor creates noise, pollution, or other negative externalities. Adjacency. The definition of the word adjacency is the state of being adjacent, or a business strategy of expanding into related markets or products. Imagine a company that makes running shoes. They already understand athletic footwear, distribution channels, and customer preferences. Expanding into athletic socks or running apparel represents adjacency, moving into closely related territory where existing knowledge and relationships provide advantages. Corporate strategists pursue adjacency growth to leverage existing capabilities while managing risk. The closer the adjacency, the lower the risk, but also potentially lower the growth opportunity. Successful adjacency moves balance familiarity with novelty. Adjustable rate preferred stock. The definition of the phrase adjustable rate preferred stock is preferred stock with dividends that fluctuate based on changes in a specified benchmark interest rate. Picture a river where the water level rises and falls with the seasons. Adjustable rate preferred stock works the same way, with dividend payments that move up and down following interest rate changes. When rates climb, dividends increase. When rates fall, dividends decrease. The flow adjusts continuously. These securities were popular in the 1980s as a way to protect investors from interest rate risk. The dividend rate typically resets quarterly based on Treasury bill rates or other benchmarks, providing some inflation protection while maintaining the preferred stock's tax advantages for corporate holders. Adjustable rate. The definition of the phrase adjustable rate is a loan or financial instrument with an interest rate that changes periodically based on an underlying benchmark. Think of a thermostat that adjusts automatically to outside temperature. When conditions change, the setting shifts accordingly. An adjustable rate loan follows this pattern, with interest charges that rise or fall based on market conditions rather than remaining fixed for the life of the loan. Adjustable rate products typically offer lower initial rates than fixed-rate alternatives, attracting borrowers who expect rates to fall or who plan to refinance before rate increases occur. However, they carry the risk that rising rates could make payments unaffordable. Adjustable rate mortgage. The definition of the phrase adjustable rate mortgage is a home loan with an interest rate that periodically adjusts based on changes in a specified index. Picture a family making mortgage payments that change over time. For the first few years, the rate might be low and steady. Then, at predetermined intervals, the rate adjusts up or down based on market conditions. The monthly payment becomes a moving target, requiring careful budgeting and planning. ARMs typically have an initial fixed period of 3, 5, 7, or 10 years, after which rates adjust annually. Rate changes are usually capped, limiting how much the rate can increase in one adjustment period or over the life of the loan. Adjusted basis. The definition of the phrase adjusted basis is the original cost of an asset, modified by certain additions and subtractions, used to calculate capital gains or losses. Think of buying a rental property for $200,000. Over the years, you add a new roof for $20,000 and claim $40,000 in depreciation. The adjusted basis is no longer $200,000. It is $180,000, the original cost plus improvements minus depreciation. This number determines your taxable gain when you sell. Adjustments to basis include improvements, casualty losses, depreciation, and certain tax credits. Accurate tracking of adjusted basis is essential for tax reporting and minimizing capital gains taxes upon sale. Adjusted gross income. The definition of the phrase adjusted gross income is total gross income minus specific deductions, used as the starting point for calculating federal income tax. Picture a paycheck stub showing total earnings at the top. Below that, certain items are subtracted, such as retirement contributions, student loan interest, and educator expenses. What remains is adjusted gross income, a key number that determines eligibility for various tax benefits and credits. AGI appears prominently on tax returns and serves as a threshold for many tax provisions. For example, medical expenses are only deductible to the extent they exceed 7.5% of AGI, and many credits phase out at higher AGI levels. Adjusting entry. The definition of the phrase adjusting entry is a journal entry made at the end of an accounting period to allocate income and expenses to the period in which they actually occurred. Imagine closing the books at month end and realizing that insurance paid for the entire year needs to be spread across 12 months. An adjusting entry records 1 month's worth of insurance expense now, ensuring the current period reflects only its fair share. It is a correction that makes the numbers honest. Common adjusting entries include accrued revenues, accrued expenses, deferred revenues, and deferred expenses. These entries ensure compliance with the matching principle, which requires expenses to be recognized in the same period as the revenues they help generate. Administered price. The definition of the phrase administered price is a price set by a producer or governing authority rather than by market forces of supply and demand. Think of a utility company setting electricity rates. The price does not fluctuate daily based on demand. Instead, a regulatory commission reviews costs and approves a rate that remains fixed for months or years. The price is administered, controlled by decision makers rather than market dynamics. Administered prices are common in regulated industries like utilities, pharmaceuticals in some countries, and agricultural products with price supports. Critics argue they create inefficiencies, while supporters claim they provide stability and protect consumers from price volatility. Administrative expense. The definition of the phrase administrative expense is the cost associated with the general operation of a business, not directly tied to production or sales. Picture an office building with hallways, conference rooms, and a human resources department. The rent for this space, the salaries of executives, the cost of office supplies, all of these are administrative expenses. They keep the organization running smoothly but do not directly create the product or generate the sale. Administrative expenses appear on the income statement as part of operating expenses. They are typically analyzed as a percentage of revenue, with companies striving to minimize this ratio while maintaining effective management and support functions. Advance. The definition of the word advance is a payment made before it is due, or a loan provided before work is completed. Think of a writer receiving money before the book is finished. The publisher provides funds up front, trusting that the completed manuscript will eventually arrive. This advance allows the writer to focus on the work without immediate financial pressure. If the book sells well, the advance is earned. If not, it may never be fully repaid. In banking, an advance refers to a short-term loan. In payroll, it means paying an employee before the regular payday. In both cases, money moves forward in time, arriving earlier than the standard schedule would dictate. Adverse event. The definition of the phrase adverse event is an unexpected occurrence that negatively affects a company's operations or financial condition. Imagine a factory running smoothly when suddenly a critical machine breaks down. Production stops. Orders are delayed. Costs mount. This is an adverse event, an unwelcome disruption that appears without warning and creates immediate problems that must be addressed. In finance, adverse events can include natural disasters, lawsuits, regulatory penalties, or sudden market shifts. Companies maintain reserves and insurance to mitigate the impact of such events, though some remain unpredictable and unavoidable. Adverse possession. The definition of the phrase adverse possession is a legal doctrine that allows a person to claim ownership of land under certain conditions, even without a deed. Picture someone maintaining an abandoned lot for years. They mow the grass, repair the fence, and pay the taxes. The original owner never appears. After a legally specified period, often 10 to 20 years, the caretaker can claim legal ownership. It is a quiet transfer of title that happens through continuous use rather than purchase. Requirements for adverse possession vary by jurisdiction but typically include open, notorious, exclusive, and continuous possession for a statutory period. The possession must be hostile, meaning without the owner's permission. Adverse selection. The definition of the phrase adverse selection is a situation where one party in a transaction has more information than the other, leading to unfavorable outcomes. Think of an insurance company offering health policies. People who know they are sick are more likely to buy coverage than healthy people. The company ends up with a pool of high-risk customers, while low-risk individuals opt out. This imbalance, driven by hidden information, is adverse selection. The concept applies broadly in economics. Used car markets face adverse selection when sellers know more about vehicle defects than buyers. Credit markets experience it when risky borrowers seek loans more aggressively than safe borrowers. Solutions include screening, signaling, and mandatory participation requirements. Affidavit. The definition of the word affidavit is a written statement confirmed by oath or affirmation, used as evidence in legal proceedings. Picture someone sitting in an office with a notary public. They read a statement aloud, swear that it is true, and sign the document while the notary watches and applies an official seal. The affidavit becomes a formal record, a sworn testimony that carries legal weight even outside a courtroom. Affidavits are commonly used in real estate transactions, court filings, and financial disclosures. Making a false statement in an affidavit constitutes perjury, a criminal offense which encourages truthfulness and accuracy. Affiliate. The definition of the word affiliate is a company or entity that has a relationship with another through common ownership or control. Think of a family of companies. One parent corporation owns several smaller businesses. These subsidiaries are affiliates of each other, connected through their shared owner. They may operate independently day to day, but financial decisions and strategy often flow from the common parent. In securities regulation, affiliates include subsidiaries, parent companies, and entities under common control. Affiliate transactions require disclosure because they may not occur at arm's length prices. Tax authorities scrutinize affiliate dealings to prevent profit shifting and tax avoidance. After-tax income. The definition of the phrase after-tax income is the amount of income remaining after all taxes have been deducted. Picture a paycheck with two numbers. The top number shows gross earnings, what was earned before any deductions. The bottom number, smaller and quieter, shows what actually arrives in the bank account after federal, state, and local taxes are removed. This is after-tax income, the true take-home amount. For businesses, after-tax income is net income, the bottom line of the income statement. For individuals, it determines actual purchasing power and standard of living. Financial planning typically focuses on after-tax figures rather than pre-tax earnings. Aftermarket. The definition of the word aftermarket is the market for securities or products after their initial sale or offering. Imagine a new stock being sold to the public for the first time. Investors buy shares directly from the company. The next day, those same shares trade on the stock exchange between investors. This secondary trading is the aftermarket, where securities change hands without involving the original issuer. In the aftermarket, prices are determined by supply and demand among investors rather than by the issuing company. Strong aftermarket performance indicates investor confidence, while weak aftermarket trading can signal concerns about the security's value. Agency. The definition of the word agency is a relationship where one party, the agent, is authorized to act on behalf of another party, the principal. Think of a real estate agent showing houses on behalf of a seller. The agent has authority to schedule tours, present offers, and negotiate terms, but the final decision rests with the homeowner. This is an agency relationship, where one person represents another's interests with delegated power. Agency relationships are governed by agency law, which defines the duties agents owe to principals. These include loyalty, obedience, disclosure, confidentiality, and reasonable care. Principals can be held liable for an agent's actions within the scope of their authority. Agency bond. The definition of the phrase agency bond is a debt security issued by a government-sponsored enterprise or federal agency. Picture a bond that is not quite a treasury security but carries implicit government backing. Agencies like Fannie Mae and Freddie Mac issue these bonds to fund their operations. They offer slightly higher yields than treasuries because they carry marginally more risk, though most investors consider them nearly as safe. Agency bonds include securities from the Federal Home Loan Banks, the Federal Farm Credit Banks, and the Tennessee Valley Authority. Though not explicitly guaranteed by the federal government, most investors assume the government would intervene to prevent default. Agency cost. The definition of the phrase agency cost is the expense arising from conflicts of interest between principals and agents in a business relationship. Imagine shareholders who want maximum profit and managers who prefer comfortable salaries and low risk. These misaligned interests create costs. Shareholders spend money monitoring managers, implementing controls, and providing incentives. These expenditures, along with any remaining loss from imperfect alignment, are agency costs. Agency costs include monitoring costs, bonding costs, and residual loss. Examples include auditing expenses, executive compensation packages designed to align interests, and the opportunity cost of foregone profitable projects that managers avoided due to personal risk aversion. Agency problem. The definition of the phrase agency problem is the conflict of interest inherent when one party is expected to act in another's best interest. Think of a corporate executive making decisions for shareholders. The executive's personal goals might include job security, prestige, and a generous salary. Shareholders want profit maximization and risk-taking when appropriate. These goals do not always align, creating an agency problem that requires careful structuring of incentives and oversight. Common manifestations include excessive executive compensation, empire building through unnecessary acquisitions, and resistance to takeovers that would benefit shareholders. Solutions include stock-based compensation, independent boards, and active shareholder engagement. Agency security. The definition of the phrase agency security is a debt instrument issued by a government-sponsored enterprise. Picture securities that sit in a space between government bonds and corporate bonds. They are issued by federally chartered organizations with public missions, such as financing home mortgages or farm credit. While not direct government obligations, they carry perceived government support, making them highly rated and widely held. Agency securities typically offer yields slightly above Treasury securities but below corporate bonds of similar maturity. They are popular with institutional investors seeking safe, liquid investments with modestly higher returns than treasuries. Agent. The definition of the word agent is a person or entity authorized to act on behalf of another in business or legal matters. Think of someone standing in for another at a negotiation. The agent speaks with authority, makes commitments, and signs documents. But the underlying power comes from the principal, the person who granted permission for the agent to act. The agent is the hand, but the principal is the mind directing it. Agents must act in their principal's best interest, disclose material information, and avoid conflicts of interest. Common examples include real estate agents, insurance agents, and talent agents. The scope of an agent's authority can be express, implied, or apparent based on the principal's words and actions. Aggregate. The definition of the word aggregate is a total or whole formed by combining several separate elements. Think of a pile of sand. Each grain is tiny and individual, but together they form a mound with measurable volume and weight. In economics, aggregate measures combine individual data points into meaningful totals. Aggregate demand sums all spending in an economy. Aggregate supply totals all production. These broad measures reveal patterns invisible at the individual level. Aggregate statistics help policymakers and analysts understand overall economic conditions. While individual behavior may be erratic, aggregate data smooths out anomalies and shows underlying trends across entire markets or economies. Aggregate demand. The definition of the phrase aggregate demand is the total demand for all goods and services in an economy at a given price level and time period. Picture every purchase made in a country during 1 year. Households buying groceries, companies purchasing equipment, governments building roads, and foreign buyers acquiring exports. All of this spending added together creates aggregate demand. It represents the economy's total appetite for goods and services. Aggregate demand is typically shown as a downward-sloping curve, reflecting that lower price levels encourage more spending. It consists of consumption, investment, government spending, and net exports. Changes in aggregate demand drive economic expansions and contractions. Aggregate limit. The definition of the phrase aggregate limit is the maximum amount an insurance policy will pay for all covered losses during a policy period. Imagine an insurance policy as a bucket filled with a specific amount of money. Each claim dips into the bucket, removing some funds. The aggregate limit is the total amount in the bucket at the start. Once that money is exhausted, no matter how many separate claims occur, the policy pays nothing more until it renews. This differs from per occurrence limits, which cap individual claims. A policy might have a $1 million per occurrence limit and a $3 million aggregate limit, meaning it covers multiple claims but stops paying once cumulative claims reach $3 million. Aggregate supply. The definition of the phrase aggregate supply is the total output of goods and services produced in an economy at a given price level. Think of every factory, farm, and service provider working throughout the year. The sum of everything they produce is aggregate supply. It represents the economy's capacity to create goods and services. In the short run, this capacity is relatively fixed. In the long run, it grows with population, technology, and capital investment. The aggregate supply curve is typically upward sloping in the short run, showing that higher prices incentivize more production. In the long run, it becomes vertical at the economy's potential output, representing full employment of resources. Aggressive growth fund. The definition of the phrase aggressive growth fund is a mutual fund that seeks maximum capital appreciation through high-risk investment strategies. Picture a portfolio filled with small startup companies, emerging market stocks, and speculative technology firms. The fund manager pursues rapid growth, accepting significant volatility and the real possibility of substantial losses. This is not a place for cautious investors. It is designed for those willing to endure sharp fluctuations in pursuit of outsized gains. Aggressive growth funds typically invest in small-cap stocks, initial public offerings, and companies with high price-to-earnings ratios. They may use leverage and derivatives to amplify returns. These funds suit investors with long time horizons who can withstand considerable short-term losses. Aging schedule. The definition of the phrase aging schedule is a table that categorizes accounts receivable by how long they have been outstanding. Imagine organizing unpaid invoices into separate piles. One pile holds invoices less than 30 days old. Another contains those between 30 and 60 days old. A third pile has invoices over 90 days old, now worryingly late. This organization is an aging schedule, showing at a glance which receivables are fresh and which are becoming problematic. Companies use aging schedules to monitor collection effectiveness and estimate bad debt reserves. The older a receivable, the less likely it is to be collected. Invoices over 90 days past due may have collection rates below 50%. Agreement of sale. The definition of the phrase agreement of sale is a legal contract outlining the terms under which property will be transferred from seller to buyer. Picture two people sitting at a table with a document between them. The paper lists the property address, the purchase price, the closing date, and various conditions that must be met. Both parties sign, creating a binding commitment. The property has not changed hands yet, but the agreement sets the process in motion. This document, also called a purchase agreement or sales contract, typically includes contingencies such as financing approval, satisfactory inspection results, and clear title. It protects both parties by establishing clear expectations and timelines. Air rights. The definition of the phrase air rights is the property rights to use the space above a piece of land. Think of ownership extending not just across the ground but upward into the sky. In dense cities, a landowner might sell the right to build above their property while retaining the ground-level parcel. A developer buys these air rights and constructs a tower that literally floats above the original building. The space itself becomes a commodity. Air rights are particularly valuable in urban areas with height restrictions. Historic buildings often sell their unused development rights to nearby properties, allowing taller construction elsewhere while preserving the original structure. Railroads and transit authorities frequently sell air rights above their tracks. Airdrop. The definition of the word airdrop is the distribution of cryptocurrency tokens to wallet addresses, often for free, as a marketing or reward mechanism. Imagine waking up to find digital tokens deposited in your cryptocurrency wallet. You did not purchase them or request them. They simply appeared, sent by a project trying to build awareness or reward early supporters. This is an airdrop, a distribution method unique to digital assets. Airdrops serve various purposes including marketing new projects, rewarding loyal users, and decentralizing token ownership. Recipients may need to meet certain criteria such as holding specific tokens, completing tasks, or being early users of a platform. Alienation. The definition of the word alienation is the transfer of property ownership from one person to another. Picture a deed changing hands. One name is crossed out and replaced with another. The property is alienated, moved from one owner to a new one. The term sounds cold and distant because it describes the fundamental separation of property from its previous owner, a severing of the legal connection. Alienation can be voluntary, such as through sale or gift, or involuntary, such as through foreclosure or eminent domain. Some properties have alienation clauses that restrict transfer, requiring lender approval before ownership can change. All risk. The definition of the phrase all risk is an insurance policy that covers all perils except those specifically excluded in the policy language. Think of insurance coverage as a large umbrella. An all-risk policy assumes the umbrella covers everything unless the policy explicitly cuts out certain exceptions. Fire, theft, water damage, most events are covered automatically. Only the dangers specifically listed as exclusions fall outside the umbrella's protection. All-risk policies, also called open perils policies, shift the burden to the insurer to prove a loss is excluded rather than requiring the policyholder to prove it is covered. They offer broader protection than named perils policies, which only cover specifically listed dangers. All-cash deal. The definition of the phrase all-cash deal is a transaction where the buyer pays the entire purchase price in cash rather than using financing or exchanging stock. Picture a real estate closing where the buyer arrives with a cashier's check for the full amount. No mortgage company participates. No monthly payments will follow. The transaction is clean, immediate, and final. The seller receives complete payment instantly, and the buyer owns the property free and clear. All-cash deals typically close faster and with greater certainty than finance transactions. Sellers often accept lower offers from cash buyers because they avoid financing contingencies and appraisal requirements. In mergers and acquisitions, all-cash deals provide immediate value to target shareholders. All or none order. The definition of the phrase all or none order is a trading instruction requiring that an order be executed in its entirety or not at all. Think of placing an order to buy 1,000 shares of stock. You specify all or none, meaning if only 800 shares are available, you want 0 shares. The order sits waiting until the full 1,000 shares can be purchased in a single transaction. Partial fulfillment is rejected outright. These orders protect investors from accumulating odd lots or paying multiple commissions for partial fills. However, they reduce the likelihood of execution, especially for large orders in thinly traded securities. Brokers may charge higher fees for all or none orders due to their execution difficulty. Allocation. The definition of the word allocation is the process of distributing or assigning resources among various uses or recipients. Picture a budget meeting where a fixed sum of money must be divided among competing departments. Marketing wants more for advertising. Research needs new equipment. Each dollar can only go to one place, so careful decisions determine the allocation. The choices reflect priorities and shape future outcomes. In investing, allocation refers to distributing capital among asset classes such as stocks, bonds, and cash. Asset allocation is considered the primary determinant of portfolio performance, more important than individual security selection according to numerous studies. Allocation efficiency. The definition of the phrase allocation efficiency is a state where resources are distributed in a way that maximizes overall economic welfare. Imagine an economy where every resource finds its most productive use. Labor works where it creates the most value. Capital flows to the best opportunities. Nothing is wasted or misplaced. This ideal state is allocation efficiency, where the entire system operates at maximum effectiveness. Perfectly competitive markets theoretically achieve allocation efficiency, with prices guiding resources to their highest value uses. In reality, market failures, externalities, and imperfect information prevent complete efficiency, though markets generally allocate resources better than centralized planning. Allocation fund. The definition of the phrase allocation fund is a mutual fund that distributes investments across multiple asset classes such as stocks, bonds, and cash. Think of a balanced meal on a dinner plate. Part of the plate holds protein, part holds vegetables, and part holds grains. Each component serves a different nutritional purpose, and together they create a complete meal. An allocation fund works the same way, combining different investment types to create a balanced portfolio in a single fund. These funds may have fixed allocations, such as 60% stocks and 40% bonds, or dynamic allocations that shift based on market conditions or the investor's age. Target date retirement funds are common examples of allocation funds. Allowance. The definition of the word allowance is an amount set aside to cover expected losses or expenses, or a deduction permitted for tax purposes. Picture a company reviewing its accounts receivable and recognizing that some customers will never pay. Rather than waiting for each default, the company creates an allowance, setting aside money today to cover these anticipated losses. It is a realistic acknowledgement that not everything owed will be collected. Tax allowances reduce taxable income by permitting deductions for specific expenses or circumstances. Personal allowances, once common on tax returns, have been largely replaced by standard deductions and credits in recent tax reforms. Allowance for doubtful accounts. The definition of the phrase allowance for doubtful accounts is a contra-asset account that estimates the portion of accounts receivable that may not be collected. Imagine a ledger showing $100,000 owed by customers. Experience suggests that about $5,000 will never arrive. The allowance for doubtful accounts holds this $5,000, reducing the reported receivables to $95,000. It is an honest adjustment that reflects economic reality rather than hopeful thinking. This allowance is estimated using historical collection rates, aging schedules, and current economic conditions. When specific accounts are determined to be uncollectible, they are written off against this allowance, avoiding a sudden impact on earnings. Alpha. The definition of the word alpha is the excess return of an investment relative to a benchmark index, measuring a manager's skill in generating returns. Think of two runners on a track. One simply matches the pace of the lead runner, staying exactly even. The other runs slightly faster, pulling ahead. That extra speed, the margin beyond matching, is alpha. In investing, it represents performance above what the market delivers, the value added by active management. An alpha of 0 means performance matched the benchmark after adjusting for risk. Positive alpha indicates outperformance, while negative alpha shows underperformance. Generating consistent positive alpha is difficult, with most active managers failing to do so after fees. Alpha generation. The definition of the phrase alpha generation is the process or strategy of creating returns that exceed a benchmark through skillful investment decisions. Picture an investment manager analyzing companies, identifying undervalued stocks, and timing market movements. Each successful decision adds a small increment of outperformance. Over time, these increments accumulate into alpha generation, the measurable proof that skill rather than luck is driving results. Alpha generation strategies include security selection, sector rotation, market timing, and factor investing. The challenge is consistency, as random variation can produce temporary outperformance that disappears over longer periods. Alternative assets. The definition of the phrase alternative assets is investments outside traditional stocks, bonds, and cash, including real estate, commodities, private equity, and hedge funds. Think of a portfolio that looks beyond the stock exchange. It might include farmland in Iowa, a stake in a private software company, gold bars in a vault, or a share of an art collection. These alternative assets behave differently than stocks and bonds, potentially providing diversification and unique return opportunities. Alternative assets typically have lower liquidity, higher fees, and less transparency than traditional investments. They often require larger minimum investments and longer holding periods, making them more suitable for institutional and high-net-worth investors. Alternative investment. The definition of the phrase alternative investment is any investment that falls outside conventional asset classes of stocks, bonds, and cash. Imagine an investor looking beyond the familiar territory of publicly traded securities. They might invest in a vineyard, a portfolio of patents, or a fund that bets on weather derivatives. These alternative investments offer exposure to different risk and return profiles than traditional markets provide. Common alternative investments include hedge funds, private equity, venture capital, real estate, commodities, and collectibles. They may offer hedge against inflation, low correlation with stock markets, or access to unique opportunities unavailable in public markets. Alternative minimum tax. The definition of the phrase alternative minimum tax is a parallel tax system designed to ensure high-income taxpayers pay at least a minimum amount of tax. Picture two tax calculations running side by side. One uses regular tax rules with all available deductions and credits. The other, the AMT, adds back certain deductions and applies a flat rate. The taxpayer pays whichever calculation produces the higher tax. It is a backstop preventing wealthy individuals from using deductions to eliminate their tax liability entirely. The AMT was created in 1969 after reports that high-income individuals paid no federal income tax. It disallows certain deductions like state and local taxes and applies rates of 26 or 28%. Many middle-income taxpayers were caught by AMT before reforms in 2017 significantly increased exemption amounts. Altcoin. The definition of the word altcoin is any cryptocurrency other than Bitcoin. Think of Bitcoin as the original digital currency, the template from which thousands of variations emerged. Each alternative coin, or altcoin, offers some modification to Bitcoin's design. Some process transactions faster. Others promise greater privacy or different consensus mechanisms. They exist in Bitcoin's shadow but seek to improve upon or differentiate from the original. Altcoins include Ethereum, Ripple, Litecoin, and thousands of others. Some serve specific use cases like smart contracts or cross-border payments. Others are speculative tokens with little underlying utility. The altcoin market is highly volatile and many projects fail. Altman Z-score. The definition of the phrase Altman Z-score is a formula that predicts the probability of a company entering bankruptcy within 2 years. Imagine a financial health checkup condensed into a single number. The Z-score combines 5 financial ratios covering liquidity, profitability, leverage, and activity. A score above 3 suggests financial strength. A score below 1.8 indicates high bankruptcy risk. The middle zone represents uncertainty, where careful monitoring is warranted. Developed by Edward Altman in 1968, the formula has proven remarkably accurate for manufacturing companies. It is less reliable for financial firms and service companies. The score provides an early warning system, allowing investors and creditors to identify distressed companies before obvious signs of failure appear. Amalgamation. The definition of the word amalgamation is the combination of 2 or more companies into a new entity, with the original companies ceasing to exist. Think of 2 metals melted together to form an alloy. Neither original metal remains separate. Both contribute to something new with different properties than either possessed alone. In business, amalgamation works similarly, creating a fresh corporate entity while dissolving the predecessors. Amalgamation differs from a merger, where one company survives and absorbs the other. It also differs from acquisition, where a buyer maintains its identity and the target becomes a subsidiary. Amalgamation creates genuine newness, often with a new name and combined leadership. Amended return. The definition of the phrase amended return is a revised tax return filed to correct errors or omissions on a previously submitted return. Picture discovering a mistake months after filing taxes. A deduction was missed, or income was reported incorrectly. Rather than letting the error stand, an amended return corrects the record. It shows the original figures, the corrections, and the resulting change in tax owed or refund due. Taxpayers typically file Form 1040-X to amend federal returns. Amendments can be filed within 3 years of the original filing date or within 2 years of paying the tax, whichever is later. Amended returns can result in additional refunds or reveal additional tax owed. American Depositary Receipt. The definition of the phrase American Depositary Receipt is a negotiable certificate representing shares of a foreign company, allowing it to trade on U.S. stock exchanges. Think of a foreign company's stock wrapped in an American package. The actual shares remain in the home country, held by a custodian bank. American investors buy ADRs, which represent ownership of those underlying shares. This structure allows trading in dollars on U.S. exchanges without requiring the foreign company to fully comply with all domestic listing requirements. ADRs make international investing more accessible by eliminating currency conversion and foreign settlement procedures. They pay dividends in dollars and are subject to U.S. securities regulations. Sponsored ADRs have the foreign company's cooperation, while unsponsored ADRs are created by brokers without company involvement. American Option. The definition of the phrase American option is an option contract that can be exercised at any time before or on the expiration date. Imagine holding a ticket that grants entry to an event. An American option is like a ticket that lets you enter any time before the show ends, not just at a specific moment. This flexibility has value because you can choose the optimal time to exercise based on changing circumstances. American options are more valuable than European options, which can only be exercised on the expiration date. However, most American options are sold before expiration rather than exercised, as selling captures time value while exercising forfeits it. American Style Option. The definition of the phrase American Style Option is another term for an American option, emphasizing the exercise flexibility. Picture 2 doors. One can be opened only at a predetermined time. The other can be opened whenever you choose before a deadline. The second door offers American-style flexibility, valuable because circumstances change and early exercise might become advantageous. This flexibility particularly benefits put options during sharp market declines, allowing holders to lock in gains immediately rather than waiting for expiration. Most stock options in the United States are American style, while most index options are European style. AML, anti-money laundering. The definition of the phrase AML or anti-money laundering is a set of laws, regulations, and procedures designed to prevent criminals from disguising illegally obtained funds as legitimate income. Think of money flowing through the financial system like water through pipes. Anti-money laundering controls act as filters, catching suspicious transactions and identifying unusual patterns. Banks monitor large cash deposits, international transfers, and rapid movement of funds between accounts. Each irregularity triggers scrutiny, making it harder to clean dirty money. AML programs require financial institutions to verify customer identities, maintain transaction records, and report suspicious activity to government authorities. Compliance costs are substantial, but the regulations help combat terrorism financing, drug trafficking, and organized crime. Amortization. The definition of the word amortization is the gradual reduction of a debt through regular payments, or the allocation of an intangible asset's cost over its useful life. Picture a mortgage payment made each month. Part pays interest, part reduces the loan balance. Slowly, steadily, the amount owed shrinks. After 30 years of payments, the debt reaches zero. This gradual elimination is amortization, a methodical path from owing everything to owing nothing. In accounting, amortization also refers to expensing intangible assets like patents or copyrights over time. A patent with a 20-year life might be amortized at 5% per year, spreading its cost across the periods that benefit from it. Amortization of intangibles. The definition of the phrase amortization of intangibles is the systematic allocation of the cost of intangible assets over their useful economic lives. Imagine purchasing a trademark for $1 million with an expected useful life of 10 years. Each year, $100,000 is recorded as amortization expense, gradually reducing the asset's book value. The trademark still exists, but its accounting value diminishes annually until fully amortized. Common intangible assets subject to amortization include patents, copyrights, trademarks, and customer lists. Goodwill, however, is not amortized but instead tested annually for impairment. The amortization period should reflect the asset's useful life, typically between 5 and 40 years. Amortization of premium. The definition of the phrase amortization of premium is the gradual reduction of a bond's book value when purchased above par value. Think of buying a bond for $1,050 that will pay exactly $1,000 at maturity. That extra $50, the premium, represents the price paid for above-market interest rates. Each period, a portion of the premium is amortized, reducing the bond's carrying value until it reaches $1,000 at maturity. Premium amortization ensures that the bondholder's yield matches the market rate at purchase rather than the higher coupon rate. The amortization reduces interest income each period, creating a more accurate reflection of the investment's true return. Amortization period. The definition of the phrase amortization period is the length of time over which a loan will be fully repaid through regular payments. Picture a timeline stretching from today into the future. A mortgage might have an amortization period of 30 years, with 360 monthly payments scheduled along that timeline. Each payment is calculated to ensure the balance reaches zero exactly when the period ends. The amortization period determines payment size and total interest paid. Longer amortization periods produce lower monthly payments but higher total interest costs. A 30-year mortgage might cost twice as much in total interest as a 15-year mortgage for the same loan amount, even though monthly payments are more manageable. Amortization schedule. The definition of the phrase amortization schedule is a table showing each payment on a loan, breaking down the portions going to principal and interest. Imagine a spreadsheet with rows for every payment over the life of a loan. Each row shows the payment date, the total payment amount, how much reduces principal, how much covers interest, and the remaining balance. Early payments are mostly interest. Later payments are mostly principal. The schedule maps the entire journey from full debt to complete payoff. Lenders provide amortization schedules at closing, allowing borrowers to see exactly how their loan will be repaid. The schedule shows how extra principal payments accelerate payoff and reduce total interest, making it a valuable tool for financial planning. Amortized cost. The definition of the phrase amortized cost is the accounting method for measuring certain financial instruments, recording them at original cost adjusted for amortization and impairment. Think of a bond purchased at a discount for $950 with a face value of $1,000. Under amortized cost accounting, the bond's value gradually increases over time as the discount is accreted. At maturity, it reaches exactly $1,000. The carrying value reflects economic reality rather than daily market fluctuations. Amortized cost provides stability in financial reporting for securities held to maturity. Unlike fair value accounting, which marks securities to market prices, amortized cost ignores temporary price changes and focuses on the instrument's expected cash flows. Amortizing bond. The definition of the phrase amortizing bond is a bond that pays both principal and interest with each payment, gradually reducing the outstanding balance. Picture a bond that behaves like a mortgage. Instead of receiving only interest until maturity when all principal is returned, each payment includes both interest and some principal repayment. The bond's face value shrinks over time, eventually reaching zero. Mortgage-backed securities are common examples of amortizing bonds. Amortizing bonds reduce reinvestment risk for issuers and provide steady cash flow to investors. However, they create prepayment risk, as the pace of principal repayment can vary based on underlying loan behavior, particularly in mortgage-backed securities. Anchoring. The definition of the word anchoring is a cognitive bias where individuals rely too heavily on an initial piece of information when making decisions. Think of a stock that once traded at $100 per share. It now trades at $60. Investors fixate on that $100 anchor, viewing $60 as cheap regardless of current fundamentals. The historical price becomes a mental reference point that distorts judgment, even when circumstances have changed dramatically. Anchoring affects negotiations, valuations, and investment decisions. Initial asking prices, first offers, and historical highs create anchors that influence subsequent judgments. Awareness of this bias helps decision-makers focus on current facts rather than arbitrary reference points. Angel investor. The definition of the phrase angel investor is an individual who provides capital to start-up companies in exchange for equity ownership, typically during early stages. Picture an entrepreneur with an idea but no funding. Traditional lenders won't touch such an unproven venture. An angel investor, often a successful business person, steps in with personal funds. The investment is risky, the company might fail. But if it succeeds, the angel's early stake could multiply tremendously. Angel investors typically invest between $25,000 and $500,000 per deal. They often provide mentorship and connections in addition to capital. Most angel investments fail, but occasional successes can generate hundredfold returns, making the overall portfolio profitable. Animal spirits. The definition of the phrase animal spirits is a term describing the emotions and instincts that drive human economic behavior, particularly confidence and fear. Imagine the mood of an entire economy swinging between optimism and pessimism. When animal spirits are high, businesses invest, consumers spend, and markets rise. Everyone feels confident. When animal spirits fall, caution prevails, spending contracts, and recession threatens. These psychological forces move markets as powerfully as any mathematical model. The term was popularized by economist John Maynard Keynes, who recognized that human psychology drives economic cycles. Central banks and governments attempt to influence animal spirits through policy, trying to restore confidence during downturns and cool excessive optimism during booms. Annual coupon. The definition of the phrase annual coupon is the total interest payment a bondholder receives in 1 year, expressed as a dollar amount. Think of a bond with a face value of $1,000 and a 5% coupon rate. The annual coupon is $50, the amount the bondholder receives each year. This payment might arrive in two $25 installments every 6 months, but the annual total is $50, steady and predictable. The coupon rate is set when the bond is issued and remains fixed for the bond's life, regardless of market interest rate changes. This predictability makes bonds attractive to income-focused investors who value stability over growth. Annual percentage rate. The definition of the phrase annual percentage rate is the yearly cost of borrowing expressed as a percentage, including interest and certain fees. Picture two loan offers with the same interest rate but different fees. One charges an origination fee, the other doesn't. The April accounts for these differences, showing the true annual cost of each loan. It allows apples-to-apples comparison by incorporating fees into a single percentage figure. Federal law requires lenders to disclose April on consumer loans, making it easier to compare offers. April is particularly useful for credit cards and mortgages, where various fees can significantly affect total cost. However, April assumes the loan is held to maturity, which may not reflect actual borrower behavior. Annual percentage yield. The definition of the phrase annual percentage yield is the effective annual rate of return on an investment, taking into account the effect of compounding interest. Think of a savings account offering 5% interest compounded monthly. The APY is slightly higher than 5% because interest earns interest throughout the year. Each month's interest payment becomes principal for the next month's calculation, creating a compounding effect that boosts the total annual return. APY allows accurate comparison between accounts with different compounding frequencies. An account with 5% interest compounded daily has a higher APY than one with 5% compounded annually, even though the stated rate is identical. Annual report. The definition of the phrase annual report is a comprehensive document that public companies provide to shareholders detailing financial performance and operations for the past year. Imagine a thick booklet arriving in the mail or appearing online. It contains financial statements, management discussion, descriptions of business operations, and notes about future plans. The annual report is part business summary, part legal disclosure, and part marketing document, offering a complete picture of the company's year. Public companies are required to file annual reports with the Securities and Exchange Commission. The formal filing, called Form 10-K, contains detailed financial statements and risk disclosures. Many companies also produce glossier shareholder versions with photographs and narrative descriptions of achievements. Annualize. The definition of the word annualize is to convert a rate or figure covering a period shorter than 1 year into an annual equivalent. Think of a company earning $10,000 in the first quarter. To annualize this figure, multiply by 4, projecting $40,000 for the full year. This conversion allows comparison with annual budgets and prior year results. It assumes current trends continue, translating partial data into a yearly framework. Annualization is common in financial analysis for returns, growth rates, and expenses. A monthly return of 2% annualizes to approximately 26.8%, accounting for compounding. However, annualized figures can be misleading if the sample period is not representative of typical conditions. Annuitant. The definition of the word annuitant is a person who receives payments from an annuity. Picture someone who converted a lump sum into a stream of monthly checks that arrive like clockwork. The annuitant sits at the kitchen table each month, opening an envelope with a payment inside. The amount never changes. It continues for life or a specified period, providing predictable income regardless of market conditions. Annuitants exchange a large sum for payment certainty. The annuity provider assumes longevity risk, promising payments even if the annuitant lives longer than actuarial tables predict. This protection against outliving savings makes annuities popular in retirement planning. Annuity. The definition of the word annuity is a financial product that pays a fixed stream of payments to an individual, typically used for retirement income. Think of reversing a mortgage. Instead of making monthly payments to eventually own a house, you give a lump sum to an insurance company and receive monthly payments for the rest of your life. The annuity converts accumulated wealth into steady income, removing the uncertainty of how long savings must last. Annuities come in many forms including immediate, deferred, fixed, and variable. Some guarantee payments for life, others for a specific period. While they provide income security, annuities typically offer lower returns than market investments and may have high fees and limited liquidity. Annuity contract. The definition of the phrase annuity contract is a legal agreement between an individual and an insurance company detailing the terms of an annuity arrangement. Imagine a formal document outlining exactly how an annuity will work. It specifies the premium amount, the payment schedule, beneficiary designations, and surrender charges. The contract is binding, governing the relationship between annuitant and insurer for decades. Every detail matters because this document determines future financial security. Annuity contracts include provisions for death benefits, withdrawal penalties, and payment options. They are regulated as insurance products and offer tax-deferred growth. Understanding contract terms is essential, as early withdrawals typically trigger surrender charges and tax penalties. Annuity due. The definition of the phrase annuity due is a series of payments made at the beginning of each period rather than at the end. Think of paying rent. The first payment is due when you move in, at the start of the month, not at the end. Each subsequent payment arrives at the beginning of its period. This timing difference, small as it seems, affects present value calculations. Money received sooner is worth more, making an annuity due more valuable than an ordinary annuity with the same payment amounts. Leases and insurance premiums are typically structured as annuities due. The present value formula for an annuity due multiplies the ordinary annuity formula by 1 plus the interest rate, reflecting the time value advantage of earlier payments. Anti-dilution provision. The definition of the phrase anti-dilution provision is a contractual clause protecting investors from ownership percentage reduction when new shares are issued at lower prices. Picture an early investor buying 10% of a startup at $10 per share. Later, the company struggles and issues new shares at $5. Without protection, the original investor's percentage ownership shrinks. An anti-dilution provision adjusts the investor's conversion price downward, maintaining their ownership stake despite the down round. Common types include full ratchet, which adjusts to the lowest price, and weighted average, which considers both price and quantity of new shares. These provisions protect early investors but can significantly dilute founders and employees. Antitrust. The definition of the word antitrust is laws designed to promote competition and prevent monopolies and anti-competitive business practices. Think of rules preventing any single company from dominating a market so thoroughly that competition disappears. Antitrust laws stop mergers that would create monopolies, prohibit price-fixing agreements, and prevent predatory pricing designed to eliminate competitors. The goal is maintaining competitive markets that benefit consumers through lower prices and better products. Major U.S. antitrust laws include the Sherman Act, the Clayton Act, and the Federal Trade Commission Act. Enforcement agencies review mergers, investigate anti-competitive conduct, and can break up monopolies. Violations can result in fines, structural remedies, or criminal prosecution. Antitrust law. The definition of the phrase antitrust law is specific legislation prohibiting practices that restrict competition or create monopolies. Imagine a legal framework that treats excessive market power like a disease requiring treatment. Antitrust law provides the diagnosis criteria and remedies. It defines what constitutes illegal monopolization, outlines prohibited agreements between competitors, and establishes standards for reviewing mergers. Each law creates boundaries that companies must respect. The Sherman Act of 1890 was the first federal antitrust law, declaring monopolies and restraints of trade illegal. The Clayton Act of 1914 addressed specific practices like price discrimination and exclusive dealing. These laws evolved through court interpretations, creating a complex body of competition law. API, Application Programming Interface. The definition of the phrase API or Application Programming Interface is a set of protocols allowing different software applications to communicate and share data. Think of a restaurant menu. Customers don't need to know how the kitchen operates. They simply choose from the menu, and food appears. An API works similarly, providing a menu of functions that external programs can request without understanding internal workings. One application asks, the API delivers, enabling seamless data exchange between systems. Financial APIs allow applications to access market data, execute trades, and retrieve account information. Banks provide APIs for third-party developers, enabling innovations like budgeting apps and payment services. APIs drive the modern financial technology ecosystem. Applicable federal rate. The definition of the phrase applicable federal rate is the minimum interest rate that the IRS allows for private loans to avoid tax consequences. Picture loaning money to a family member. The IRS requires charging at least a minimum interest rate, the AFR, even on private loans. Charge less, and the IRS may impute interest income to you anyway, creating phantom taxable income. The AFR ensures that loans between related parties reflect economic reality rather than disguised gifts. The IRS publishes AFRs monthly for short-term, mid-term, and long-term loans. Rates vary based on loan duration and current market conditions. Using AFR protects lenders from having below-market loans recharacterized as taxable gifts. Apportionment. The definition of the word apportionment is the division and allocation of costs, expenses, or tax liability among multiple parties or jurisdictions. Think of an insurance claim affecting multiple policy years. The loss must be apportioned across the relevant periods, with each year bearing its fair share. Or consider a multi-state business allocating income to different states based on sales, property, and payroll. Apportionment ensures fair distribution based on rational formulas. Tax apportionment prevents double taxation while ensuring each jurisdiction receives appropriate revenue. States use apportionment formulas to divide corporate income among states where the company operates. Similarly, expenses are apportioned in accounting to match costs with the periods or departments that benefit. Appraisal. The definition of the word appraisal is a professional assessment of an asset's value, typically real estate, conducted by a qualified appraiser. Picture someone walking through a house with a clipboard, measuring rooms, noting condition, and comparing similar properties recently sold. The appraiser considers location, condition, improvements, and market trends. Days later, a formal report arrives stating the property's estimated market value. This appraisal becomes the foundation for loan approvals and purchase decisions. Lenders require appraisals before approving mortgages to ensure the collateral justifies the loan amount. Appraisers must be licensed and independent, following standardized methods. Appraisals protect both lenders and borrowers by providing objective value assessments. Appreciation. The definition of the word appreciation is the increase in value of an asset over time. Think of a house purchased for $200,000. 10 years later, it sells for $300,000. The $100,000 increase is appreciation, the natural growth in value from market forces, improvements, or inflation. Appreciation builds wealth passively, rewarding patient owners who hold assets through market cycles. Asset appreciation can result from inflation, increased demand, improvements, or favorable economic conditions. Stock appreciation comes from earnings growth and multiple expansion. Real estate appreciates due to location desirability, development, and scarcity. Appreciation is typically taxed only when realized through sale. Appropriation. The definition of the word appropriation is the allocation of funds for a specific purpose, or legislative authorization to spend public money. Picture a government budget process where lawmakers designate exactly how money will be spent. $10 million for road repairs. $5 million for schools. Each appropriation dedicates funds to a particular use, preventing money from drifting to unauthorized purposes. The appropriation creates both permission to spend and limits on how much. In business, appropriation refers to setting aside retained earnings for specific purposes like equipment replacement or debt retirement. Appropriated retained earnings remain part of equity but are earmarked for designated uses rather than being available for dividends. Arbitrage. The definition of the word arbitrage is the simultaneous purchase and sale of an asset in different markets to profit from price differences. Think of discovering apples selling for $1 at one grocery store and $1.50 at another store across town. Buy apples at the first store, immediately sell them at the second, and pocket the 50-cent difference. Arbitrage works the same way, exploiting temporary price discrepancies that exist across markets. The profit is nearly risk-free because both transactions happen simultaneously. Arbitrage opportunities typically disappear quickly as traders exploit them, bringing prices back into alignment. Common forms include currency arbitrage, merger arbitrage, and statistical arbitrage. Professional arbitrageurs provide market efficiency by eliminating price discrepancies. Arbitrage bot. The definition of the phrase arbitrage bot is an automated software program that identifies and executes arbitrage opportunities in financial markets. Picture a computer program watching thousands of cryptocurrency exchanges simultaneously. When Bitcoin trades for $50,000 on one exchange and $50,050 on another, the bot instantly buys on the cheaper exchange and sells on the more expensive one. The entire transaction completes in milliseconds, capturing tiny profits repeated thousands of times daily. Arbitrage bots are common in cryptocurrency markets where price fragmentation across exchanges creates frequent opportunities. High-frequency trading firms use similar bots in traditional markets. Success requires speed, low transaction costs, and sophisticated algorithms. Arbitrage opportunity. The definition of the phrase arbitrage opportunity is a situation where the same asset trades at different prices in different markets, allowing risk-free profit. Imagine a stock trading at $100 on the New York Stock Exchange and $102 on a foreign exchange. For a brief moment, this price gap creates an arbitrage opportunity. Buy at 100, Sell at 102, capture $2 per share with virtually no risk. These opportunities are rare and fleeting in efficient markets. True arbitrage opportunities require no capital investment and carry no risk, as opposite positions are taken simultaneously. In practice, most opportunities involve small price differences and require significant capital and speed to profit meaningfully. Arbitrage pricing theory. The definition of the phrase arbitrage pricing theory is an asset pricing model that describes the relationship between risk and expected return using multiple factors. Think of a stock's return driven by several forces. Interest rate changes affect it. Oil prices matter. Economic growth plays a role. Arbitrage pricing theory recognizes that returns depend on multiple systematic factors, not just overall market movement. Each factor carries a risk premium, and the stock's expected return equals the risk-free rate plus compensation for each factor exposure. APT was developed as an alternative to the capital asset pricing model. While CAPM uses a single market factor, APT allows multiple factors. However, APT doesn't specify which factors matter, leaving factor selection to the analyst's judgment. Arbitrage strategy. The definition of the phrase arbitrage strategy is an investment approach designed to profit from price inefficiencies between related securities or markets. Picture a strategy focused on exploiting temporary mispricings rather than predicting market direction. Convertible arbitrage buys convertible bonds and shorts the underlying stock. Merger arbitrage buys target companies and shorts acquirers. Statistical arbitrage uses quantitative models to identify mispriced pairs. Each strategy seeks low-risk profits from price convergence. Successful arbitrage strategies require sophisticated analysis, rapid execution, and careful risk management. While often marketed as low risk, many arbitrage strategies carry hidden risks that materialize during market stress, as occurred with long-term capital management's collapse in 1998. Arbitrage-free. The definition of the phrase arbitrage-free is a market condition where no risk-free profit opportunities exist due to price discrepancies. Imagine a perfectly balanced market where every asset is priced correctly relative to every other asset. No gaps exist. No free money lies on the table waiting to be picked up. This is an arbitrage-free market, the theoretical ideal where prices reflect all available information and opportunities for risk-free profit have been eliminated. Arbitrage-free pricing is a fundamental assumption in derivatives pricing models. Options, futures, and swaps are priced to prevent arbitrage opportunities, ensuring consistent valuations across related instruments. Deviations from arbitrage-free conditions quickly attract traders who restore balance. Arbitrageur. The definition of the word arbitrageur is a person or firm that engages in arbitrage trading. Think of a market specialist who makes a living finding tiny price discrepancies. The arbitrageur sits with multiple screens displaying prices across different exchanges and markets. When a gap appears, they act instantly, buying low and selling high simultaneously. They take no directional bets, seeking only to capture temporary inefficiencies. Arbitrageurs provide valuable market services by improving price efficiency and market liquidity. Their activities narrow bid-ask spreads and align prices across markets. While individual trades yield small profits, high volume and leverage can generate substantial returns. Arm's length transaction. The definition of the phrase arm's length transaction is a deal between unrelated parties acting in their own self-interest, establishing fair market value. Picture two strangers negotiating a car sale. Neither owes the other favors. Both seek the best possible deal. The price they agree upon reflects true market value because each party bargains independently. This is an arm's length transaction, free from the influences of relationship, obligation, or shared interest. Tax authorities scrutinize transactions between related parties to ensure they occur at arm's length prices. Transfer pricing rules require multinational companies to price intercompany transactions as if they were dealing with unrelated parties, preventing profit shifting to low-tax jurisdictions. Arrears. The definition of the word arrears is payments that are overdue or made at the end of a period rather than the beginning. Think of a bill that was due last week but remains unpaid. The account is in arrears, behind schedule with an obligation. Or consider a bond that pays interest in arrears, meaning each payment covers the period just ended rather than the period ahead. Being in arrears can indicate financial difficulty or simply describe a payment timing convention. Preferred dividends are often cumulative, meaning dividends in arrears must be paid before common shareholders receive anything. Debt payments in arrears beyond a grace period typically trigger default provisions, damaging credit ratings and potentially accelerating the entire loan balance. Articles of incorporation. The definition of the phrase articles of incorporation is the legal document filed with a state to formally establish a corporation. Picture the birth certificate of a company. The articles of incorporation name the corporation, specify its purpose, define its stock structure, and identify initial directors. Filed with the Secretary of State, this document brings the corporation into legal existence. Once approved, the corporation becomes a separate legal entity with rights and obligations distinct from its owners. Articles of incorporation include the company name, registered agent, authorized shares, and incorporator information. Some states require minimal disclosure while others demand detailed provisions. Amendments to the articles typically require shareholder approval and state filing. Asian option. The definition of the phrase Asian option is a derivative whose payoff depends on the average price of the underlying asset over a period rather than the price at a single point. Think of an option that looks at the journey rather than just the destination. Instead of valuing the underlying asset at expiration, an Asian option averages prices over days, weeks, or months. A sudden price spike or crash on the final day matters less because the average smooths volatility. This structure reduces manipulation risk and provides more stable outcomes. Asian options are cheaper than standard options because averaging reduces volatility and therefore value. They are popular in commodity markets and currency hedging where average prices better reflect economic exposure than spot prices at single moments. Ask. The definition of the word ask is the lowest price at which a seller is willing to sell a security. Picture a marketplace where sellers post their asking prices. One offers to sell stock at $50 per share. Another asks $50.05. The lowest ask represents the best available selling price at that moment. Buyers looking to purchase immediately must accept this ask price or wait hoping it will fall. The ask is always higher than the bid, the highest price buyers are willing to pay. The difference between bid and ask is the spread, representing transaction costs and market maker profit. Narrow spreads indicate liquid markets while wide spreads suggest illiquidity. Ask price. The definition of the phrase ask price is the same as the ask, the price at which a seller offers to sell a security. Think of entering a store where everything has a price tag. The ask price is that tag, the amount the seller demands. In financial markets, ask prices change constantly as new sellers enter with different prices and old offers are accepted and removed. The ask price represents current supply conditions at that moment. Market orders to buy execute at the current ask price, while limit orders only execute if the ask falls to the specified level or below. Monitoring ask price movements helps traders understand selling pressure and market sentiment. Assessed value. The definition of the word assessed value is the dollar value assigned to property by a public tax assessor for property tax purposes. Picture a county assessor reviewing your property. They consider the land size, building square footage, age, condition, and recent sales of comparable properties. They assign a value that may differ from market value. This assessed value determines your annual property tax bill, calculated by multiplying assessed value by the local tax rate. Assessed values are typically lower than market values and updated periodically, often every few years. Property owners can appeal assessments they believe are too high. Assessment ratios, the relationship between assessed and market value, vary by jurisdiction. Assessment. The definition of the word assessment is the process of determining the value of property for tax purposes, or a charge imposed on property owners for improvements. Think of two meanings under one word. First, the routine evaluation determining how much your property is worth for tax calculations. Second, a special charge levied when the local government installs new sewers or paves roads, with costs allocated among property owners who benefit. Both types of assessment create financial obligations for property owners. Special assessments appear as separate line items on tax bills and may be payable over several years. They finance improvements that benefit specific properties rather than the general public. Property owners sometimes contest assessments, arguing their share is disproportionate to benefits received. Asset. The definition of the word asset is anything of value owned by an individual or organization that can provide future economic benefit. Think of everything you own that has worth. A house, a car, a savings account, a share of stock. Each is an asset, a resource that could be sold, used, or leveraged. Assets appear on balance sheets, representing the accumulated wealth and productive capacity of their owner. They are the building blocks of financial security. Assets are classified as current, convertible to cash within 1 year, or non-current, held for longer periods. Tangible assets like equipment have physical form. Intangible assets like patents exist only as legal rights. Total assets minus total liabilities equals net worth or equity. Asset allocation. The definition of the phrase asset allocation is the investment strategy of dividing a portfolio among different asset categories such as stocks, bonds, and cash. Picture a pie divided into slices of different sizes. One large slice represents stocks. Another holds bonds. A small slice contains cash. This division is asset allocation, the fundamental decision determining portfolio risk and return. The mix reflects the investor's goals, time horizon, and risk tolerance. It matters more than individual security selection. Studies suggest asset allocation explains over 90% of portfolio return variability over time. Young investors typically allocate more to stocks for growth. Retirees shift toward bonds for income and stability. Rebalancing periodically maintains target allocations as market movements alter proportions. Asset-backed security. The definition of the phrase asset-backed security is a financial instrument backed by a pool of underlying assets, typically loans or receivables. Think of thousands of auto loans bundled together into a single package. Investors buy securities representing shares of this package, receiving payments as borrowers repay their loans. The security is backed by the underlying car loans, with the vehicles themselves serving as collateral. Asset-backed securities transform illiquid loans into tradable investments. Common types include securities backed by auto loans, credit card receivables, student loans, and equipment leases. The securitization process allows lenders to remove loans from their balance sheets, freeing capital for new lending. Credit quality depends on the underlying borrowers and structural protections. Asset class. The definition of the phrase asset class is a group of investments with similar characteristics and market behaviors. Imagine organizing investments into broad categories. Stocks form one class, generally offering growth but with volatility. Bonds constitute another, providing income with less price fluctuation. Real estate, commodities, and cash each represent distinct classes with unique risk-return profiles. Diversifying across asset classes reduces portfolio risk. Asset classes respond differently to economic conditions. Stocks typically outperform during expansions. Bonds shine during slowdowns. Commodities hedge inflation. Understanding these patterns guides allocation decisions and helps investors build resilient portfolios that weather various economic environments. Asset gathering. The definition of the phrase asset gathering is the process by which investment managers attract new client funds to increase assets under management. Picture a wealth management firm hosting seminars, advertising services, and meeting potential clients. Each successful pitch brings new assets under management. The firm gathers assets like a farmer gathering crops, knowing that larger AUM generates higher fee revenue even if percentage rates remain constant. Growth comes from attracting new money, not just generating returns. Asset gathering can conflict with client interests if firms prioritize growth over performance. Large asset bases may reduce flexibility and returns, particularly in strategies with limited capacity. Firms sometimes close funds to new investors when asset gathering would harm existing client returns. Asset manager. The definition of the phrase asset manager is a professional or firm that manages investments on behalf of clients. Think of someone entrusted with other people's money, making daily decisions about buying and selling securities. The asset manager studies markets, analyzes companies, and constructs portfolios aligned with client objectives. They bear responsibility for achieving returns while managing risk, acting as a fiduciary serving their clients' best interests. Asset managers include mutual fund companies, pension fund managers, hedge funds, and individual portfolio managers. They earn fees based on assets under management, typically ranging from 0.5 to 2% annually. Performance fees may provide additional compensation for exceeding benchmarks. Asset mix. The definition of the phrase asset mix is the combination of different asset types within a portfolio. Picture a recipe listing ingredients and proportions. 60% stocks, 30% bonds, 10% cash. This is the asset mix, the specific blend determining portfolio characteristics. A conservative mix holds more bonds and cash. An aggressive mix tilts heavily toward stocks. The mix is customized to match individual circumstances and goals. Asset mix evolves over time as investors age and circumstances change. Target date funds automatically adjust the mix, reducing equity exposure as retirement approaches. Regular rebalancing maintains the intended mix despite market movements that alter proportions. Asset purchase. The definition of the phrase asset purchase is a transaction where a buyer acquires specific assets of a company rather than purchasing the company's stock. Think of buying the equipment, inventory, and customer lists of a business without acquiring the legal entity itself. The buyer cherry-picks desired assets while leaving behind liabilities, lawsuits, and unwanted obligations. Asset purchases provide control over exactly what transfers, reducing risk but often creating more complex transactions. Asset purchases allow buyers to avoid hidden liabilities and receive step-up in tax bases for acquired assets. However, transferring contracts, licenses, and permits can be challenging as each may require third-party consent. Sellers typically face higher taxes on asset sales compared to stock sales. Asset stripping. The definition of the phrase asset stripping is the practice of buying an undervalued company and selling its assets separately for profit. Picture a company worth more in pieces than as a whole. An acquirer buys it cheaply, then sells the real estate, equipment, and divisions to different buyers. The sum of part sales exceeds the purchase price, generating profit. This is asset stripping, controversial because it often destroys the operating business and eliminates jobs. Asset stripping thrived during the 1980s leveraged buyout boom. Critics argue it destroys productive enterprises for short-term gain. Defenders claim it reallocates resources to higher value uses, improving economic efficiency. Laws now restrict asset stripping that harms creditors or pension obligations. Asset swap. The definition of the phrase asset swap is a derivative transaction that exchanges the cash flows of one asset for another, often swapping fixed-rate payments for floating-rate payments. Think of two parties exchanging payment streams. One holds a fixed-rate bond but wants floating-rate exposure matching their liabilities. Another has floating-rate income but prefers fixed payments. They enter an asset swap, each receiving the desired cash flow pattern without selling the underlying asset. The swap transforms economic exposure while retaining original ownership. Asset swaps allow investors to modify risk characteristics without transaction costs of selling securities. They are common in fixed income markets, allowing managers to adjust interest rate exposure quickly. The swap agreement specifies payment dates, calculation methods, and termination provisions. Asset turnover ratio. The definition of the phrase asset turnover ratio is a measure of how efficiently a company uses its assets to generate sales revenue. Imagine a factory producing goods. The asset turnover ratio divides annual sales by total assets, showing how many dollars of revenue each dollar of assets generates. A ratio of 2 means the company produces $2 of sales for every dollar invested in assets. Higher ratios indicate more efficient asset utilization. Asset-intensive industries like utilities have low turnover ratios, often below 1. Retail and service businesses typically show higher ratios, sometimes exceeding 3. Comparing ratios across industries is misleading, but trends within a company over time reveal improving or deteriorating efficiency. Asset under management. The definition of the phrase asset under management is the total market value of investments that a financial institution manages on behalf of clients. Picture all the money entrusted to an investment firm, added together into one massive total. This is assets under management, or AUM, a key metric determining firm size and revenue. A firm with $10 billion in AUM managing money for thousands of clients earns fees on that entire base, making AUM growth a primary business objective. AUM fluctuates with market performance and client contributions or withdrawals. Firms report AUM quarterly, breaking it down by strategy and client type. Investment performance increases AUM through gains, while strong sales efforts bring new client assets. Fee revenue typically equals AUM multiplied by the fee rate. Assets available for sale. The definition of the phrase assets available for sale is securities that a company intends to sell before maturity but not immediately. Think of investments sitting in a middle category. They are not trading securities bought for quick profit. They are not hold-to-maturity securities locked away until they mature. Instead, they are available for sale, meaning the company might sell them if conditions warrant but has no immediate plans. This classification affects accounting treatment and financial reporting. Available for sale securities are reported at fair value on the balance sheet, with unrealized gains and losses recorded in other comprehensive income rather than earnings. This treatment reduces earnings volatility while providing transparent valuation. When sold, accumulated gains or losses transfer to the income statement. Assignment. The definition of the word assignment is the transfer of rights or property from one party to another, or the notification that an option has been exercised against a seller. Picture two scenarios under one term. First, assigning a contract transfers your rights and obligations to someone else, like assigning a lease when you move. Second, in options trading, assignment means you must fulfill your obligation. If you sold a call option and the buyer exercises it, you are assigned and must deliver the shares at the strike price. Option assignment is random among sellers with open positions when exercise occurs. Assignment risk is highest for in-the-money options near expiration. Short option positions carry unlimited assignment risk on American-style options exercisable anytime before expiration. Assignment options. The definition of the phrase assignment in options is the process by which an option seller is required to fulfill the terms of the contract after the buyer exercises. Think of selling a call option on stock you own. The buyer decides to exercise, wanting to purchase your shares at the strike price. You receive an assignment notice requiring you to deliver the shares. Assignment is not optional. Once notified, you must complete the transaction regardless of current market conditions or your preferences. Assignment occurs through a random selection process among all short positions in that option series. Sellers cannot predict when assignment will happen, though it typically occurs when options are in the money near expiration. Dividend dates and early exercise provisions affect assignment probability. Assignment of income. The definition of the phrase assignment of income is a tax doctrine preventing taxpayers from avoiding taxes by transferring income to others after it has been earned. Picture earning a paycheck then immediately giving it to your child who pays lower taxes. The assignment of income doctrine says you still owe tax on those earnings. Income is taxed to the person who earned it, regardless of who ultimately receives the money. This prevents tax avoidance through simple transfers after income is realized. The doctrine applies broadly to wages, dividends, interest, and capital gains. Properly structured gifts of income-producing property can shift future income to recipients, but income already earned remains taxable to the earner. Advanced planning is essential to achieve legitimate income shifting. Assumable mortgage. The definition of the phrase assumable mortgage is a home loan that can be transferred from the seller to the buyer when property is sold. Think of buying a house and taking over the existing mortgage instead of getting a new loan. The interest rate, remaining balance, and payment terms transfer with the property. If rates have risen since the original loan, an assumable mortgage with a lower rate becomes valuable, potentially commanding a higher sale price. Most conventional mortgages contain due-on-sale clauses preventing assumption. However, FHA and VA loans are typically assumable, subject to lender qualification of the new borrower. Buyers assuming mortgages must still qualify based on income and credit, though they avoid some closing costs. Assured. The definition of the word assured is the person or entity covered by an insurance policy, also called the insured. Picture the name listed on an insurance policy, the party protected by the coverage. If disaster strikes, the assured receives payment or benefits according to policy terms. They pay premiums in exchange for this protection, transferring risk to the insurance company. The assured is the reason the policy exists. In life insurance, the assured is the person whose life is insured. In property insurance, the assured owns the covered property. Multiple parties can be assured under one policy, such as joint mortgage holders both covered by homeowners insurance. At issue. The definition of the phrase at issue is the moment when a bond or security is first issued and sold to investors. Think of the starting point, when a new bond leaves the issuer and enters the market. At issue, the bond has its full term remaining, no payment history exists, and price equals par value in most cases. Everything is fresh and new. This moment establishes the baseline from which all future pricing and performance is measured. At-issue pricing reflects current market conditions, issuer creditworthiness, and term structure. Yield spreads at issue indicate how much premium investors demand above Treasury rates. Primary market participants purchase at issue, then may immediately sell in secondary markets. At par. The definition of the phrase at par is when a security trades at its face value or nominal value. Picture a bond with a face value of $1,000 trading for exactly $1,000. It is at par, neither at a premium nor a discount. This occurs when the coupon rate equals current market interest rates for similar bonds. No adjustment is needed. The bond's stated value matches its market price perfectly. Newly issued bonds typically price at par, with coupon rates set to match market conditions. Existing bonds trade at par only when their fixed coupon rates equal prevailing rates for comparable securities. As rates change, bond prices adjust, moving above or below par. At the money. The definition of the phrase at the money is an option whose strike price equals the current market price of the underlying asset. Think of a call option with a strike price of $50 on a stock trading at $50. The option is at the money, sitting exactly on the line between profit and loss. Exercise provides no immediate gain, but any upward movement creates value. At-the-money options have maximum time value and are most sensitive to price changes. At-the-money options have delta near 50%, meaning they gain about 50 cents for each dollar the underlying moves favorably. They represent the transition point between in-the-money and out-of-the-money options, making them popular for strategies seeking balanced risk exposure. At-will employment. The definition of the phrase at-will employment is an employment relationship where either party can terminate the arrangement at any time without cause or advance notice. Picture a job with no contract specifying duration or termination procedures. Either the employer or employee can end the relationship immediately for any legal reason or no reason at all. This is at-will employment, the default arrangement in most U.S. states, offering flexibility but little job security. At-will employment does not permit termination for illegal reasons such as discrimination or retaliation. Implied contracts, employee handbooks, and verbal promises can modify at-will status. Some states recognize exceptions protecting whistleblowers and employees who refuse illegal directives. Atomic swap. The definition of the phrase atomic swap is a peer-to-peer exchange of cryptocurrencies from different blockchains without requiring a trusted third party. Think of trading Bitcoin for Ethereum directly with another person, with no exchange or intermediary involved. Smart contracts ensure that either both sides of the trade complete simultaneously or neither does. The swap is atomic, meaning indivisible and instant. Both parties receive their assets or the transaction fails completely, preventing either party from cheating. Atomic swaps use hash-time-locked contracts to coordinate cross-chain transfers. They eliminate exchange fees, custody risk, and regulatory barriers. However, they require both blockchains to support specific technical features and currently remain less convenient than centralized exchanges. Attained age. The definition of the phrase attained age is the current age of an insured person, used to calculate insurance premiums. Picture an insurance policy that adjusts cost as you grow older. Your attained age, your current age right now, determines this year's premium. As birthdays pass, attained age increases, and typically so does the cost of coverage. This reflects rising risk as age advances, particularly in health and life insurance. Attained age pricing contrasts with issue age pricing, where premiums are based on age when the policy was purchased. Attained age policies start cheaper but increase steadily. Issue age policies cost more initially but rise slower over time. The choice affects long-term affordability. Attestation. The definition of the word attestation is the act of witnessing the signing of a document and confirming its authenticity through signature or seal. Think of signing a will while witnesses watch, then having those witnesses sign confirming they observed the process. This attestation validates the document's authenticity. The witnesses attest that the signature is genuine, that the signer appeared competent, and that no coercion occurred. Their attestation gives the document legal weight. Notarization is a formal type of attestation where a notary public verifies identity and witnesses' signatures. Financial statements may be attested by auditors confirming accuracy. Attestation creates an independent verification record, reducing fraud and disputes. Attribution analysis. The definition of the phrase attribution analysis is a process that breaks down portfolio returns to identify which decisions contributed to performance. Imagine examining why a portfolio gained 8% when its benchmark gained 6%. Attribution analysis separates the 2% excess into components. How much came from sector allocation? How much from security selection within sectors? How much from timing decisions? Each choice is isolated and measured, revealing what worked and what didn't. Attribution helps investors understand whether outperformance resulted from skill or luck. It distinguishes manager decisions from market movements. The analysis can be decomposed by asset allocation, security selection, timing, and interaction effects, providing detailed performance insights. Auction. The definition of the word auction is a public sale where goods or securities are sold to the highest bidder. Picture a room where buyers raise their hands, each offering more than the last. The auctioneer calls out rising prices until no one will bid higher. The final bidder wins the item at the last offered price. Auctions efficiently discover market value by allowing demand to set prices through open competition. Financial auctions include treasury security sales, IPO allocations, and art sales. Different formats exist, including English auctions with ascending bids, Dutch auctions with descending prices, and sealed bid auctions where offers are submitted privately. Each format suits different assets and objectives. Auction market. The definition of the phrase auction market is a market where buyers and sellers submit competitive bids and offers simultaneously, with trades occurring when bid and ask prices match. Think of the New York Stock Exchange where buy and sell orders continuously flow in. Buyers specify maximum prices they will pay. Sellers name minimum prices they will accept. When a bid meets or exceeds an ask, a trade executes. This continuous auction process determines prices through real-time supply and demand interaction. Auction markets contrast with dealer markets where intermediaries buy and hold inventory. The auction format provides price transparency and allows many participants to compete equally. Electronic trading has largely replaced floor-based auction markets, but the fundamental mechanism remains unchanged. Auction rate security. The definition of the phrase auction rate security is a long-term debt instrument with interest rates reset through periodic auctions. Picture a bond with a 30-year maturity but an interest rate that resets every 7 or 28 days through an auction. Investors bid on the interest rate they require. The lowest rate sufficient to sell the entire issue becomes the new rate for the next period. This structure provides long-term funding at short-term rates. Auction rate securities collapsed during the 2008 financial crisis when auctions failed due to lack of bidders. Investors expecting liquidity found themselves trapped in illiquid long-term securities. Many issuers were forced to redeem securities at par or face lawsuits from stranded investors. Audit. The definition of the word audit is an independent examination of financial records, statements, or operations to verify accuracy and compliance. Think of an outsider reviewing every transaction, checking that rules were followed and numbers add up correctly. The auditor examines ledgers, confirms bank balances, inspects documentation, and tests internal controls. After thorough investigation, they issue an opinion on whether financial statements fairly represent the company's position. This independent verification builds trust. External audits are required for public companies and many private organizations. Auditors follow generally accepted auditing standards, maintaining independence from management. Audit opinions range from unqualified clean bills of health to qualified or adverse opinions signaling problems. Audits deter fraud and improve financial reporting quality. Audit trail. The definition of the word audit trail is a chronological record of financial transactions that allows verification and accountability. Picture footprints in fresh snow, each step showing exactly where someone has walked. An audit trail is those footprints in the financial world, marking every transaction so the path can be retraced. Audit trails ensure transparency, help detect fraud, and are crucial for compliance with regulations. They provide evidence for auditors and protect organizations from disputes. Augmentation. The definition of the word augmentation is the process of increasing or enhancing financial value, resources, or capacity. Imagine a small stream being fed by tributaries, growing into a powerful river. Augmentation is that growth, the strengthening of financial resources through expansion. In finance, augmentation can refer to capital increases, revenue growth, or asset enhancement. It signals progress and the ability to scale operations. Authorization. The definition of the word authorization is formal approval to carry out a financial transaction or action. Picture a gatekeeper handing you a key that unlocks access to a vault. Authorization is that key, the permission that makes financial movement possible. Authorization protects against fraud, ensures accountability, and is required for payments, contracts, and investments. It is a cornerstone of financial control systems. Autonomy. The definition of the word autonomy in finance is the ability of an individual or organization to govern its own financial decisions independently. Think of a ship sailing freely across the ocean, charting its own course without external control. Autonomy is that freedom in financial management. Financial autonomy means independence from external funding or oversight. It reflects stability, self-sufficiency, and the power to make strategic choices without constraint. Available for sale securities. The definition of available for sale securities is financial assets, such as stocks or bonds, that are not held for trading but can be sold before maturity. Picture a fruit basket on display. You don't plan to eat it immediately, but it's available if needed. These securities are that basket, held for flexibility. They are reported at fair value, with unrealized gains or losses recorded in equity. They provide liquidity while balancing long-term investment goals. Average cost. The definition of average cost is the total cost of goods divided by the number of units produced or purchased. Imagine baking a batch of cookies. You add up the cost of flour, sugar, and butter, then divide by the number of cookies. That's the average cost. It helps businesses set prices, measure efficiency, and evaluate profitability. In investing, average cost is used to calculate the mean purchase price of securities. Avoidable cost. The definition of avoidable cost is an expense that can be eliminated if a particular activity or decision is discontinued. Picture a traveler deciding not to take a toll road. By choosing a different route, the toll fee is avoided. That's an avoidable cost. In finance, avoidable costs are crucial for decision-making. They help managers identify savings opportunities and evaluate whether to continue or stop projects. Award. The definition of award in finance is a monetary settlement, grant, or recognition given as compensation or incentive. Think of a medal ceremony where winners receive not only a trophy but also a financial prize. An award is that prize in the financial realm. Awards can be legal settlements, grants, or employee bonuses. They recognize achievement, resolve disputes, or provide financial support. Axiom. The definition of axiom in finance is a foundational principle or rule accepted as true without proof, guiding financial reasoning. Picture the roots of a tree, unseen but essential, supporting all growth above. An axiom is that root in financial theory. Examples include higher risk demands higher return, or time value of money. Axioms shape models, strategies, and decisions across economics and finance. And with that final definition, we close the ledger for tonight. The alphabet of wealth is vast, but there is no need to master it all in one sitting. For now, let the terms we've discussed, the assets, the liabilities, and the steady flow of capital, fade into the background of your mind. If you found peace in tonight's journey, remember that this library is always here for you, growing one quiet letter at a time. If you enjoyed this video, please consider liking and subscribing to the channel. For other helpful financial resources, check the links in the description. Which word put you to sleep? We'd love to know, leave it in the comments below. But for now, the business of the day is concluded. The markets are silent. Your mind is still, and your only remaining task is to rest. I am Simon Grant, thank you for listening to this video. Good night.